Please like, share, and subscribe. Wishing you happiness and good luck every day.
Have you ever felt that gut-wrenching mix of greed and fear while you're watching your stocks? You are definitely not alone. But what if you could trade all those emotions for a clear, research-backed method for actually picking stocks? Well, today, that's what we're doing. We're breaking down a data-driven guide to finding potential winners in the market.
Okay, so let's dive right into this by looking at a situation that's, well, it's probably all too familiar for a lot of investors. It's that classic story of a great stock pick that somehow, just somehow, turns into a painful loss. So, this quote, this is from an investor in our source material. Let's just call him John. He buys a stock, he watches it more than double, and he's dreaming of it being a 10-bagger. But when the market turned, he just held on. And that dream, it turned into a staggering 70% loss. Ouch.
I mean, come on. Have you ever felt like that? You know, that feeling of watching a huge paper profit just evaporate? Or maybe kicking yourself for selling way too early, only to see a stock just shoot for the moon without you? This whole emotional roller coaster is the central dilemma for so many of us.
But what if we could just step off that roller coaster for good? What if there was a way to replace all those hunches and gut feelings with a systematic approach that's grounded in hard data? Well, that's exactly what our source materials set out to find. So we are digging into the work of Thomas Bulkowski. This guy spent years, and I mean years, analyzing market data to test dozens and dozens of investment strategies. He wasn't really interested in theories, he wanted to see what actually worked, what consistently produced results over time.
So, how does the research suggest we find these winning stocks? Well, it starts by taking a piece of common investing wisdom and basically turning it completely on its head. Let's see what the data shows.
You've heard this before, right? The idea that the strongest, most resilient companies, the ones that barely even flinch in a downturn, are going to be the first ones to rocket higher when the market recovers. I mean, it sounds logical, but is it true?
The data says, nope, not at all. Just look at these numbers. After the 2000 bear market, the stocks that fell more than the median, the ones everyone was terrified of, they bounced back with a staggering 107% median return. And the safer stocks, the ones that fell the least, they only recovered by 29%. The conventional wisdom was just completely wrong.
So the big takeaway here is this. The research points us towards buying what it calls fallen angels. These are stocks that have just been beaten down, dropping 50% or even more. The data shows that these biggest losers in a bear market often become the biggest winners in the recovery that follows, outperforming 68% of the time in the next year.
Okay, so we're looking for beaten down stocks, but which ones? I mean, there are tons of them. Bulkowski's research dug through countless metrics to find the most powerful indicator, and one stood out way above all the others: book value.
So, to put it simply, think of book value as the company's net worth on paper. If the company were to, say, sell off all its assets and pay off all its debts, this is theoretically what would be left for the shareholders. But, as we're about to see, what a company is worth on paper is often very different from its price on the stock market. And really, that difference is everything. Book value, it's like the depreciated value of a car in a company's ledger. But market value, that's what someone is actually willing to pay for that car, or in this case, the stock, today. The key is the relationship between them, which we measure using something called the price-to-book, or P/B ratio. And this right here is where it gets really powerful. The study split stocks into two groups, those with a price-to-book ratio above the median and those below it. And the results? They weren't even close. Just look at the 5-year return. $10,000 invested in the undervalued low PSBV stocks grew to nearly $19,000. The more expensive high PSBV stocks, they only returned about $15,000. That's a $4,000 difference just from this one single metric.
The research actually gets even more specific. The absolute best performance came from stocks with the price-to-book value at or below 1.0. Now, what does that mean? It means you are literally buying the company for less than its accounting value. You're getting $1 worth of assets for less than $1. It's a fantastic deal.
So we have two powerful ingredients now: a beaten-down stock price and a low price-to-book ratio. But the research found one more factor that acts like a performance booster.
So when you filter those low price-to-book stocks by company size, a very clear winner emerges. Small cap stocks, we're talking companies with a market value under $1 billion, they dramatically outperform their larger peers.
A $10,000 investment here grew to almost $22,000, leaving mid and large caps completely in the dust. All right, we've looked at the evidence, we've seen what the data says works. Now let's combine all of these powerful findings into a simple, actionable strategy.
So here it is, the winning combination according to the research. Step 1, focus on small caps, so companies under $1 billion. Step 2, hunt for stocks with low share prices, ideally under $16. Step 3, and this is the crucial filter, demand a price-to-book ratio at or below 1.0. And finally, step 4 adds this really nice layer of quality control. Look for that P/BV ratio to be falling, meaning the stock's getting cheaper while the company's profitability, its return on equity, is actually rising. This basically signals you're buying a good company at a great price, not just a cheap one.
So what's the potential payoff for following such a strict, data-driven approach? Well, the study found that stocks meeting a similar set of criteria delivered an incredible average gain of 41% in the following year. That is the power of replacing emotion with evidence.
Now look, this research doesn't offer any guarantees, of course, but it provides a really powerful framework that's built on historical performance, not just hope. And it leaves us with a critical question to think about. Is our own approach to the market built on a solid foundation of data, or is it just a series of emotional hunches?
You know, we've all heard it, right? Buy and hold. It's supposed to be the golden rule of investing. Just set it and forget it, and you'll get rich. Simple. But what if that's not the whole story? What if there's a huge piece of the puzzle missing? Well, today, we're going to dive into the story of an investor who did everything right. He followed the rules, had some amazing success, and then boom, he watched it all just fall apart.
Okay, so just imagine this for a second. It's the 1980s bull market, and you are absolutely crushing it. I mean, a 63% win rate, an average of almost 40% on every single trade. You'd feel like a total genius, right? The author Thomas Bulkowski, he even admits he was doing all this without really knowing what he was doing. It just felt easy. And that's the trap, isn't it? That's the seductive promise of buy and hold. The idea that it's just simple.
And then, bam, reality hits. And it hits hard. On just one stock, he lost money not once, not twice, but 3 separate times. And get this, each loss was even bigger than the one before. It just makes you wonder, right? If this buy and hold thing is so great, how on earth could it lead to a total disaster like that? You can bet that experience made him rethink everything.
Yeah, this whole thing was a real roller coaster ride. And it was a tough lesson in just how fast those amazing paper gains can disappear into thin air.
You know, it wasn't even just about the final loss. It was about the what-ifs. It's that feeling, and maybe you felt it too, of being rich on paper. And then you just have to sit there and watch it all evaporate before you do anything. There was one stock in particular, ASA Holdings, that really drives this point home.
Okay, so let's follow the money here. He gets into ASA Holdings at an average price of about $23.36. Seemed like a really solid entry for a company that looked like it had a ton of potential. And wow, did his research pay off. The stock didn't just go up, it more than doubled. It hits a high of $51 a share. I mean, this is the moment every investor dreams about. The strategy's working, you feel vindicated, you feel smart, and yeah, you feel rich.
But then, the drop. Before he even had a chance to sell, the stock just plummeted, all the way from 51 down to 34. Now sure, he still made a profit, but a massive chunk of those incredible gains? Gone. Just vanished. That feeling of watching your peak wealth just evaporate, man, that is a total gut punch. And it really exposed the big problem with a strict hold forever way of thinking. So that whole experience led to a pretty big realization. The goal isn't to buy and forever. It's actually about making a really important shift in how you think about it. And here's the shift. It's simple, but it's so powerful. Most people think of buy and hold, right? It's passive. You just hold it forever. But the author's big insight was to reframe it as buy and wait. Now, this is an active strategy. You hold on until the stock's potential is met, and then you sell. See the difference? It's not about holding it permanently, it's about holding it with a purpose. So let's just break that down a bit more. Buy and wait is still a long-term game. You're buying a stock with a plan to hold it for years. You're focused on that long-term growth. But the key difference is the end game. You actually have an exit plan. You sell when the reason you bought it, when that story has played out and the potential you saw has been realized.
I love this quote because it really gets to the heart of the matter. This isn't about some rigid, unbreakable rule. It's about developing an inner voice. You know, the voice of experience. It's that little voice in your head that says, hey, you've doubled your money here. It's probably time to lock in those profits before the market decides to take them back. It's a skill you develop, not some commandment you have to follow blindly.
And what's so cool about this is that this way of thinking isn't just for the classic long-term investor. Nope, it's really a strategy for everyone. The benefits actually go way beyond what you'd expect. I mean, think about it. You might think, day traders, why would they care about a long-term strategy? But they really, really should. That constant pressure to perform every single day, that leads to serious burnout. Having a core portfolio of these buy-and-wait stocks gives you this amazing financial and, honestly, psychological cushion. It's a way to stay in the game, but in a much more relaxed, less stressful way.
So the big takeaway here is this. Think about diversifying not just across different industries, but diversifying your trading style. When you have that stable foundation of long-term holdings, it gives you the confidence and the capital to go after shorter-term plays, like swing trades, way more effectively.
So when you boil it all down, what are we really talking about? It's about adopting a true long-term mindset. That's the core philosophy. And this is maybe the most important point of all. Real long-term investing is not buy and forget. That's just, well, it's lazy. It's think long-term growth. That means you still have to pay attention. You have to keep believing in that company's future. It's an ongoing evaluation, not just a decision you make once and never look at again.
And look, this isn't just some guy's opinion he cooked up one afternoon. These insights were forged in the fire of the market. The author crunched the numbers on almost 1,000 stocks over a 16-year period. And that period included the dot-com bust. So yeah, this strategy has been battle-tested against some serious real-world craziness.
What I find kind of funny is that the author himself admits that all his deep data analysis can get super complicated. He literally asks, who cares? He gets it. He knows that the most important thing isn't to memorize all the stats, but to grasp the simple, powerful idea behind it all. At the end of the day, it's your mindset that truly matters.
So this really leaves us with one final question for you. Take a good, hard look at your own portfolio. Are you just reacting to the noise of the market today, or are you truly investing for the next decade? Are you playing the long game, and do you have a clear plan for when it's time to cash in your chips and move on? Today, we're going to challenge some of the most common advice you hear about the stock market. We're going to ditch the old, tired adages and instead use hard data from investor and author Thomas Bulkowski to figure out what really works. So let me just ask you, how much of what you think you know about investing is actually true? You know, we hear these little rules of thumb all the time, but do they really hold up when you look at the numbers? Well, today, we're putting some of the most popular beliefs to the test. You've probably heard this one before, right? It sounds super logical. When everything's going down, you stick with the stocks that showed some strength, the ones that didn't get totally crushed. They feel like the safest pick for the rebound. But is that strategy actually the one that makes you the most money? That seemingly safe advice? Well, it might actually be what we'll call the bear market trap. It feels smart, it feels conservative, but believe me, the data tells a completely different and frankly a way more profitable story. Okay, the numbers here are pretty wild. Bulkowski looked at two huge bear markets. Just focus with me on that 2000 to 2002 period. The so-called safer stocks, the ones that fell less, they bounced back about 29% a year later. Not bad. But what about the stocks that fell more than the median? They came roaring back with a median bounce of a staggering 107%. And look at the 2007-2009 crisis. It's the same pattern, but even more extreme. The lesson is kind of shocking. The bigger the fall, the bigger the bounce. And if that table wasn't clear enough, this chart just spells it out. This visualizes that 2000-2002 recovery. On the left, you've got the stocks that fell the least, a 29% recovery. But look at the right. The stocks that got hit the hardest shot back up 107%. It's not even a contest.
So with that, our first myth is officially busted. The evidence is just crystal clear. If you're looking for the biggest recovery plays after a bear market, the data tells you to look in the rubble, not at the stocks that were left standing the tallest. The biggest losers really do become the biggest winners.
All right, let's move on to our next big idea, which kind of builds on this. This one's all about momentum. Should you put your money on the stocks that have been on a tear, the winners, or the ones that have been absolutely crushed, what we call the fallen angels? It's a classic question for any investor, right? Do you ride the hot hand, thinking a stock that's on fire will just stay hot? Or do you go digging in the bargain bin, betting on a huge comeback story? Let's see what the numbers have to say about that. So for his research, Bulkowski basically split stocks into two main groups. On one side, you have the winners. These are stocks that at least doubled in price over a year. And on the other side, you've got the fallen angels, stocks that got cut in half or even worse. So what about those winners? If a stock doubled in price this year, what are the odds it's going to outperform the market next year? Well, it's just 53%. That is barely better than a coin flip. Chasing that kind of momentum is basically a gamble. But now let's look at the fallen angels. How often did a stock that got sliced in half go on to outperform the next year? A much, much more compelling 68% of the time. Now that isn't just a slight edge, that's a pretty significant statistical advantage. The big takeaway here is pretty clear. While chasing those high-flying stocks feels really exciting, the smarter, more consistent opportunity is often with good, solid companies that have just been beaten down for one reason or another. They simply have way more room to recover, and as the data shows, they do it more reliably. Okay, so we've busted two huge myths. Now let's get practical. How can you actually spot these kinds of opportunities out in the wild? I'm going to give you 3 actionable methods for finding hidden clues in the market. This first one is so simple, it's brilliant. Just buy what you know. Bulkowski talks about actually getting out there and observing. He gives this great example of hearing people rave about the retailer, Steinmart, and then its stock just took off. It's about using your own eyes and ears. If you see a store and its parking lot is always packed and the customers seem happy, that is a powerful real-world signal. That's your cue to start digging into the financials. All right, method 2 is all about finding footprints in the stock chart. Bulkowski actually studied companies that were bought out, and he found this one pattern kept showing up over and over again. This specific formation, which is called a double bottom, appeared right before a buyout in 45% of the cases he looked at. So what is a double bottom exactly? It basically looks like the letter W. The stock's price hits a low point, it bounces up for a bit, then it falls back down to roughly that same low, and then it takes off for real. The theory here is that this pattern can be a clue that insiders, the smart money, are buying up shares at a low price before some good news, like a buyout, gets announced to the public. And that brings us to our third method, following the ultimate insiders, a company's own executives. When they start buying their own stock with their own money, that's a huge vote of confidence. But, and this is a big but, not all insider buying is created equal. You really have to know how to read the signals. So it's all about the context. You're not looking for one director buying a handful of shares on some automatic, pre-scheduled plan. No, you're looking for a whole cluster of signals. Are multiple execs all buying around the same time? Are the amounts huge? Bulkowski has this great phrase for it. You want to see them backing up an 18-wheeler and filling it with stock. And is all this buying happening when the stock price is low? When you see all of that line up, that's a very powerful sign that the people who know the company best think its stock is a bargain. So we have busted some myths, we've uncovered some clues. Now let's just pull it all together and summarize the new tools you can add to your investing toolkit. Okay, here's the quick and dirty rundown. First, forget the safe stocks in a bear market. The data says the biggest losers often have the biggest rebounds. Second, you'll probably have more consistent luck with beaten down fallen angels than with recent high flyers. And to find these ideas, use your own eyes. Observe businesses you know. Learn to spot key chart patterns like that double bottom. And finally, know how to analyze insider buying so you can see what the smart money is really doing. This leaves us with one final thought. We've just seen how hard data can completely shatter some of the most common beliefs in investing. It really makes you wonder, doesn't it? What other rules of the market are we all following that are just waiting to be broken if we only took a closer look at the evidence? Today, we're going to dig into a term that gets thrown around all the time in investing, book value. You know, a lot of people see it as this solid, reliable number, an investor's safety net. But is it really what we think it is? Let's follow the data and see what we find. You know, this quote, it really hits home for a lot of people when they're just starting out. It makes perfect sense, right? If you buy a company for less than its official book value, then worst case scenario, you've got a cushion. It's a really comforting thought to have. So
That's the big question, isn't it? Is that comforting thought, that built-in safety net, actually based in reality? Or is it just one of the oldest myths in investing?
All right, so let's dive right into our first section. Before we can figure out how to use book value correctly, we first have to tear down what it isn't, and that's what we're calling the book value myth.
Okay, so what exactly is book value anyway? Well, officially, it's a company's total assets minus all its liabilities, and then that number is divided by the number of shares out there. The bottom line, it's what the accountants say the company is worth on paper. It's a historical record.
And this is probably the best way to think about it. Think of book value like the blue book price for a used car. It's a number based on the original price and some standard depreciation. But the market value, that's the price you actually get at the dealership, and it's based on what people are willing to pay for it right now. They're just not the same thing at all.
And this is where that whole safety net idea just completely evaporates. Book value is not a guarantee of anything in a bankruptcy. The source material gives this perfect, brutal example. Penn Central had a book value of over $60 a share right before it went belly up. When a company is actually liquidated, those assets on the books, they might sell for pennies on the dollar. Yeah, that safety net, turns out it was never really there. Okay, so if book value by itself is basically useless as a safety net, then why are we even talking about it? Well, this is where things get interesting, because it has a real power when you use it a different way. Let's move on and see what that is.
See, the secret isn't book value in a vacuum. It's all about how it compares to the stock price, and that relationship has a name, the price-to-book value ratio, or P/BV for short. It's a super simple idea. It just compares what the market is paying for the company to what the accountants say it's worth. Which naturally leads to the big question, right? When we're looking for good investments, what should we be looking for? Do we want a low P/BV or a high one? The answer might seem obvious, but let's see what the actual research has to say.
And the great thing is, we don't have to guess. People have studied this for decades, running the numbers again and again. So let's just look at the evidence, because in this case, the data absolutely does not lie.
I mean, look at this. The source pulls from some major studies, and the findings are just kind of mind-blowing. One study found that stocks with the lowest P/V ratios had huge excess returns. Another one found that over any 5-year period, the low P/V stocks beat the high P/V stocks 100% of the time. Think about that for a second. Every single time.
And check this out. This really shows you the power over the long haul. A study by Tweedy Brown found that if you had just invested in a specific group of low P/BV stocks back in 1970, your $1 million would have turned into, get this, over $23 million by 1982. For comparison, the S&P 500 would have only gotten you to $2.6 million. Wow. Okay, let's put this in a simple picture. If you'd invested $10,000 into stocks with a PVV ratio that was below the average, it would have grown to almost $19,000 in 5 years. And the high PVV stocks? They didn't even crack $15,000. The evidence is just crystal clear.
All right, so we've got a pretty solid starting point. Low price-to-book stocks are the way to go. But can we do even better? Can we take this winning idea and refine it, make it even more powerful? Let's find out. I mean, the results we just saw are pretty great, but what if we could refine this? What if we could stack the odds even more in our favor? Well, the data says yes, absolutely.
So first up, what happens if we only look at smaller companies? We take our group of low P/B stocks and only focus on the ones with a market cap under $1 billion. Look at that jump. Our $10,000 investment now grows to almost $22,000. It seems like the market just isn't paying as much attention to these smaller, cheaper companies.
Okay, let's add another filter to the mix. What if we take those same low PBV stocks, but this time we only buy the ones with a low stock price? The difference is just huge. The low price group turned 10 grand into more than $22,600, while the high price group was again stuck under 15,000. It's another sign that the market tends to overlook these kinds of stocks. So what we're really doing here is building a kind of value funnel. We start with a big group of low PV stocks. Then we filter that group down to just the small companies. Then we filter that group down to just the low-priced stocks. And the source suggests one last little check. Make sure their return on equity is going up. That's a great sign that the business is getting healthier, and you might have found a real winner. Okay, so let's put all the pieces together. This brings us to our final section. where we boil all this down into a strategy that's super simple, but, as we've seen, incredibly powerful. If you forget everything else, just remember this one number. The absolute sweet spot, according to the data, is a price-to-book ratio of less than 1.0. That literally means you're paying less for a share of the company than its stated value on the accountant's books. And here's a real-world example of just how simple this can be. It's called the Beat the Dow strategy. All you do is take the 30 big companies in the Dow Jones Industrial Average, rank them from lowest to highest P/BV, and then you just buy the 10 with the lowest P/BV. That's it. Hold them for a year, then do it all over again. So, did it work? You bet it did. Over the 16-year period they tested, this simple little strategy turned $10,000 into almost $40,000. If you just bought the whole Dow, you'd only have about $26,500. It's just a powerful, simple example of this principle in action. And all this leaves us with one final, kind of fascinating thought. We all spend so much time and energy looking for complicated, secret formulas for investing success. But what if the data is telling us that one of the most powerful, most consistent strategies is also one of the simplest, and it's been hiding in plain sight this whole time?
When you see a company pouring money into new factories or flashy equipment, it feels like a great sign, right? Like they're confident, they're growing, and it's a clear signal to buy their stock. But what if I told you that data actually suggests the exact opposite? We're about to dig into a really surprising paradox that lives right at the heart of how companies spend their money.
Okay, first things first, let's make sure we're all on the same page. When we talk about capital spending, or CapEx for short, we're just talking about the cash a company invests in physical stuff. New buildings, better machinery, that sort of thing. And to compare a giant company with a smaller one, we look at this spending on a per-share basis. It just keeps everything on a level playing field.
So the common sense thinking goes like this: more investment equals more growth. Seems pretty obvious, doesn't it? But what if that logic is just plain wrong? What if the hard data points us in a completely counterintuitive direction? Well, that's exactly the question we're going to tackle today. So let's start with what everybody thinks they know. A company spending big on its own future, that should be a fantastic sign for its stock. It just makes sense. And you know what's funny? The very researcher who crunched all these numbers, he started out thinking the exact same thing. And you can see it right here, in his own words. He went into his research assuming that more spending would create more value. But then, as he puts it, what I found during testing surprised me. So what exactly did he find that was so surprising? Let's get into it.
All right, enough with assumptions and conventional wisdom. Let's look at what the numbers actually say. And this isn't some small, flimsy study either. We're talking about data from almost 800 stocks tracked over 15 years. And this, my friends, is where things start to get weird.
Okay, so check this out. This is our first big piece of evidence. The study created two simple groups: the big spenders who increased their CapEx and the budget cutters who decreased it. Then they just sat back and watched how the stocks performed over the next 5 years. The setup was super simple, but the results? Well, they were shocking.
Just look at this. In that first year, the companies that increased their spending saw their stocks go up by 8%. Hey, not too bad. But the companies that cut their spending, their stocks went up a whopping 16%. That is double the return. I mean, right out of the gate, our common sense idea gets totally blown out of the water.
Now, hold on. Before you go and bet the farm on this, we got to be real. This isn't a magic crystal ball. Even though the average returns are really compelling, this strategy only picked a winning stock about 55% of the time. So you have to think of it as giving you an edge, not a guarantee.
Okay, so a single-year cut is pretty interesting. But what about a pattern? What if a company makes it a habit? Does a company that consistently cuts its spending send an even stronger signal to the market? Let's dig a little deeper and find out.
Well, this next table answers that exact question. It tracks a few different 2-year patterns. But the one we really care about is that last one on the list. What happens when a company cuts its spending 2 years in a row?
And wow, the power of that trend is just undeniable. Companies that cut spending for 2 years straight saw their stocks jump an incredible 18% the very next year. And look at the 5-year growth. A $10,000 investment balloons to over $18,500. That absolutely demolishes the return from companies that kept on spending more.
This chart really spells it out clearly. Just look what happens as companies get more and more aggressive with their spending. A modest 10% increase in CapEx gets you a decent 8% gain.
but when a company goes on a wild 90% spending spree, the stock actually loses money. It's like the market is actively punishing them for that lack of discipline.
And now for the flip side, which is where the real magic happens. It's almost a perfect mirror image. As the spending cuts get deeper, the stock returns just explode. A tiny 10% cut gets you a 17% gain. A massive 70% cut, that leads to an unbelievable 29% average gain in the following year. The market absolutely loves this kind of fiscal discipline.
Okay, so we've pretty clearly established that cutting spending is a powerful signal. But does company size matter here? I mean, does this work for a giant corporation the same way it works for a small, scrappy startup? Let's add our final variable into the mix, market capitalization, which is really just a fancy way of saying how big a company is.
And here it is, the final piece of the puzzle. This last table breaks everything down by company size, small, medium, and large. And then, inside each of those groups, it splits them into high spenders and low spenders. And honestly, the pattern is just crystal clear. It doesn't matter what size the company is, the lower spending group almost always delivered much better returns.
So what's the absolute worst performing combination you could find? It's the big companies that spend a lot of money. If you had invested $10,000 in that group, you'd end up with just over $12,000 after 5 years. Okay? Remember that number? That's our low bar.
And now for the contrast. The absolute best performing group, the small companies that kept their spending low. That same $10,000 investment, it grows to over $20,000 in 5 years. That's not just a little better, that's a whole different universe of returns. It just shows you how potent this combination of small size and spending discipline can be.
Phew, okay, that was a lot of data. So let's boil it all down. What's the bottom line? What should you actually take away from all of this? Let's get right to it. Here's the big idea. You might want to look for companies that are cutting their capital spending, not boosting it. The signal gets even stronger if they've done it for 2 years in a row, and stronger still if those cuts are deep. And the absolute sweet spot? It's the small cap companies that are being frugal. But always remember the caveat. Even in the best case scenario, this method only worked about 58% of the time. So it's a powerful indicator, but it is not an oracle.
So we'll leave you with this final thought. We're all trained to look at what companies are buying, the new headquarters, the big acquisitions. But maybe, just maybe, the real secret, the most powerful clue to a company's future, isn't found in its spending at all, but in its discipline.
When you're trying to figure out what a company is really worth, there's one member that, well, it tells the real story. It's the one metric that's incredibly hard to hide from. It's not the profit number you see in the headlines, it's cash. And today, we're going to dig into exactly why cash flow is king.
Okay, so let's jump right in. You always hear about earnings, right? Earnings per share this, profit that, but let's put that up against what actually keeps a business running. Cold, hard cash. You see, earnings, they're kind of an opinion. They depend on accounting rules and choices. But cash flow, that's a fact. It's the actual money going in and out of the bank. And at the end of the day, that's what pays the salaries and keeps the lights on.
And that's the crucial point. A company can show a loss on its income statement for years and still be perfectly fine, as long as it has cash to fund itself. I mean, think about all those early-stage biotech companies. They lose money hand over fist for years developing a new drug. But as long as investors keep putting money in and they manage that cash, they survive, all while hoping for that one big breakthrough.
So why this big difference between the profits a company reports and the cash it actually has? Well, it's because those earnings numbers can be massaged with all sorts of accounting tricks. You've probably heard the term cooking the books, and that's exactly what it is, making a company's performance look way better than it truly is.
I love this analogy because it just hits the nail on the head. It's not that faking cash flow is literally impossible, but wow, is it difficult, and it leaves a really obvious trail. Tweaking an accounting assumption to boost earnings, that's like scooping ice cream. But trying to mess with the actual cash transactions, yeah, that's like trying to swallow a bowling ball. One is just a lot harder to get away with.
So let's look at a few of these classic tricks. Channel stuffing is a big one. This is where a company forces a ton of product onto its distributors right at the end of the quarter. Boom, the sales numbers look amazing. But guess what? A lot of that product just comes right back as returns in the next quarter. Or another one, they just delay paying their own bills. It makes their bank account look a little healthier for a moment, but it's a total illusion that you'd completely miss if you only looked at that profit number. Okay, so if earnings can lie, where do we find the truth? Well, it's simple. You follow the money, and the map that shows you where it all goes is the cash flow statement. This is the document that lays everything out in the open. It shows you exactly where a company's cash came from and exactly where it went.
A company's cash flow is always broken down into these three sections. Now, cash from operating activities, that's the big one. That's the cash coming from the company's main business. Then you have investing, which shows how they're spending money to grow for the future. And finally, financing, which tells you how they're raising cash or giving it back to shareholders. Each piece tells a really important part of the story.
And this all brings us to the metric that many investors consider the holy grail, free cash flow. Basically, after a company runs its business and spends the money and needs to just maintain its assets, this is the pile of cash that's left over. This is the good stuff. This is the money they can use to pay down debt, buy back stock, pay you a dividend, or fund some new exciting growth. It's all the things that create real value. So now for the proof. Talk is cheap, but the data doesn't lie. A really important academic study looked at over 20 years of market history, all the way from 1968 to 1989. They compared stocks based on a very simple cash flow metric. And let me tell you, the results were just astounding.
So first, you had the value stocks. These were the companies that were kind of unloved, the ones with a low price-to-cash flow ratio. So for every dollar of the stock price, you were getting a whole lot of cash-generating power. And the result? These stocks returned an average of 20% per year. Just incredible.
Now compare that to the glamour stocks. These were the popular, expensive darlings of the market, the ones with high price-to-cash flow ratios. They only returned 9% a year. The value group more than doubled the return of the glamour group. The difference is just wild. But here's the real kicker. You'd think, okay, to get those higher returns, you had to take on a lot more risk, right? Nope. Actually, the study found the opposite was true. Those cash-rich value stocks actually did better when the market took a nosedive. So it was higher returns with less risk. That's the dream. So this is great info, but how can we actually use it? Well, inspired by that original study, the author of our source material decided to run their own numbers on more recent data, from 1992 to 2007, to see if a simple, practical investing strategy could be built around this one powerful idea.
And the results were just crystal clear. It didn't matter if you were looking at large, mid-size, or small companies. The stocks with a price-to-cash flow ratio below the median consistently beat the ones above it. But if you look at the numbers, you'll see that for small-cap stocks, that's where this strategy really shined.
This chart just makes it so obvious. Imagine you invested $10,000 in a group of small companies with high price-to-cash flow ratios. Over 5 years, that would have grown to about $17,000. Not bad. But if you put that same $10,000 into small companies with low price-to-cash flow ratios, it would have grown to almost $23,000. That is a massive difference, and it's all driven by that one simple filter.
So the crucial point here is that history shows us a pretty clear relationship. The more you're willing to pay for a company's cash flow, well, the lower your returns tend to be. The data just screams that finding bargains, companies that are gushing cash relative to their stock price, has been a super reliable way to get better returns.
All right, let's bring this all home with a simple checklist you can use to apply these powerful ideas. This is how you can take all this historical data and turn it into a real strategy for looking at stocks today.
So here they are, the simple rules backed by all this research. First, you want a ratio that's not just low, but ideally getting lower. The overall median in the study was about 9, so anything under that is a great place to start looking. For 1-year performance, the real sweet spot was between 1 and 2. And remember, the biggest edge was found in those small-cap stocks. And never forget that last point. This isn't about being reckless. This is a historically proven and less risky strategy.
And there you have it, our deep dive into why cash is king. So we'll leave you with this final thought as you look at your own investments. Which companies look amazing on paper, but if you dig a little deeper, might be running out of cash? Look past those earnings headlines and follow the money. It might just be the most honest story a company can tell.
Let's talk about dividends. That steady payment some companies send out to their shareholders? It seems pretty simple, right? But what if I told you that most of the common wisdom about how to pick the best dividend stocks is, well, just completely backward? And that really brings us to the big mystery we're going to solve in this explainer. What if a company's absolute worst piece of news could actually be your single greatest opportunity as an investor? Just keep that question in the back of your mind as we dive in. Okay, before we can get to any of these surprising stuff, we've got to make sure we're all on the same page. So let's start with the absolute basics. What exactly is a dividend?
At its heart, it's super straightforward. A dividend is just a slice of the profits a company makes that it decides to give back to its owners, the shareholders. Most of the time, this just shows up as cold hard cash in your brokerage account. Simple enough.
But this is where it starts to get interesting. As our source material puts it, dividends are kind of like breakfast cereals. They come in all sorts of varieties. It's not always cash. You might get a property dividend, where a company literally pays you with its own products, or a scrip dividend, which is basically an IOU. There are even liability dividends paid with debt and, illegal phony dividends. The big takeaway here is that not all payouts are the same.
All right, now that we've got the basics down, let's start playing detective. We're on the hunt for clues in the data that could point us toward a winning strategy. And our first stop is dividend yield.
It's the question that just makes sense, right? If a company pays a bigger dividend, meaning it has a higher yield, that must mean it's a better stock to own. So let's see what the research actually says about that.
So take a look at this table. What researchers did here was pretty simple. They took a ton of companies and sorted them into 4 different baskets based on their dividend yield: high, medium, low, and 0. Then they tracked how a $10,000 investment in each basket would have grown over 5 years.
And the results? Well, they're pretty striking. That 10 grand you invested in the basket of high-yield stocks, after 5 years, it would have grown to over $21,000. That totally smokes the roughly $16,500 you would have made with low-yield or no-dividend stocks. So clue number 1 is crystal clear. High yield seems to be a very, very strong signal.
But here's the thing. While a high yield is a great start, the research shows it is absolutely not the whole story. To really zero in on the best performers, we need to add another ingredient into the mix, something called the payout ratio.
The payout ratio is just the percentage of a company's earnings that it's paying out to you in dividends. So think of it like this. If a company earns $1 per share and pays you a 50-cent dividend, its payout ratio is 50%. It tells you how much profit they're returning versus how much they're keeping to, grow the business. Okay, so this next table, this is where the real secret recipe gets revealed. It combines our 2 clues, it sorts stocks by both their yield and their payout ratio, and when you do that, a much, much clearer pattern starts to pop right out.
And there it is, the winning formula, clear as day. The stocks that performed the best, gaining an average of 13.3% in the next year, were the ones with a high yield and a low payout ratio. And it makes perfect sense, right? It's the sweet spot. The company is generous enough to pay you a nice dividend, but it's also keeping plenty of cash to reinvest for future growth.
Now, let's take this one step further, because we're about to get to the most shocking, the most counterintuitive finding in this entire analysis. This is where we take that conventional wisdom and just flip it completely on its head.
So let me ask you, what is the absolute worst news a dividend-paying company can possibly announce? The one thing that makes investors hit the panic button and run for the hills? I think we all know the answer.
It's cutting the dividend. And this chart shows you exactly what happens. This is the stock price for a company called Amarin right after it announced a 39% dividend cut. The stock just fell off a cliff. Shareholders freaked out, and the price tanked. So case closed, right? A dividend cut is a total disaster.
Well, not so fast, because after that initial brutal sell-off, something really strange starts to happen if you look at the long run.
You have got to see this. This data is just stunning. It compares 2 groups of stocks over 5 years, one group that consistently increased their dividends, the good news stocks, and another that decreased them. And the results are just unbelievable. The very stocks that got punished for cutting their dividends went on to become the best long-term performers, by a lot.
And look, we are not talking about a small difference here. A $10,000 investment in the companies that were increasing their dividends grew to about $17,500. That's respectable. But that same 10 grand invested in the companies that were decreasing their dividends, it grew to almost $24,000. It wasn't even a contest.
So what on earth is going on? Well, it all comes down to psychology. The market panics. That dividend cut headline causes a massive overreaction. Everybody sells at once, and the stock price gets pushed down way, way too far. This creates a huge discount, basically a Black Friday sale, for patient investors who can see past the short-term noise.
So how do we wrap all of this up? Let's take all of these clues we found and assemble them into a new, smarter playbook for looking at dividend stocks.
First, let's just nail down a core principle here. The data is pretty clear. Over the long haul, owning stocks that pay dividends is generally a better bet than owning stocks that don't.
A $10,000 investment grew to over 18.6 versus about 16.4 without. So rule number 1, dividends matter. And now for the final piece of our puzzle. Turns out, size matters too. When you break down performance by the size of the company, the data shows that small-cap stocks, the smaller guys, that pay dividends deliver the absolute best long-term returns, turning that 10 grand into almost $21,000 in 5 years. So, if you boil everything we've learned down to one single powerful piece of advice, it's this quote from our source material: buy stocks after they cut their dividend and price bottoms. It is the ultimate contrarian move. You're running toward the fire when everyone else is running away. So in the end, a dividend isn't just a boring payment. It's a signal. It's telling you a story about a company's health, its plans, and most importantly, it's revealing how the rest of the market is thinking and feeling. The only question is, are you listening to the right signals?
All right, let's talk about corporate debt. When you're looking at a stock, is a company's debt a huge red flag? Or maybe a sign of smart growth? Friend or foe? Well, today we're going to dig into the data and find a really surprising and pretty clear answer. So, to kick things off, the author we're looking at today makes a confession that I think a lot of us can relate to. He says, flat out, I dislike debt. And he's talking about personal debt. You know, car loans, mortgages, all that stuff. And yeah, who doesn't feel that? Personal debt can feel like this huge weight on your shoulders. But here's the big question, right? Does that gut feeling we have about our own finances, that debt is bad, actually apply to the huge companies you might invest in? I mean, it seems like it should, but as we're about to see, the numbers, well, they tell a very different story. Okay, just so we're all on the same page, let's define our terms. When we talk about debt here, we're specifically talking about long-term debt. This is money the company has borrowed that isn't due for at least another 12 months. So think of it more like a strategic business loan, not their monthly credit card bill. Okay, so let's treat this like a little investigation. Every good mystery needs a first clue, right? And for us, that clue comes from asking the simplest, most obvious question first. So let's start super simple. What performs better? Companies with debt or companies with no debt? I mean, if our personal finance brains are right, the answer should be obvious. The debt-free companies should crush it. So let's see if that's true. And here's the first bit of data. And you know what? At first glance, it looks like our theory is spot on. If you check out the performance for companies with no debt in those first 3 years, they're getting these nice, steady 12% gains. They're out of the gate strong, beating the companies with debt. So far, so good. Conventional wisdom for the win, right? But then you get to year 5, and this is where it gets interesting. Let's say you put 10 grand into each group. After 5 whole years, the difference between the two is just $403. I mean, in the grand scheme of things, that's basically a rounding error. It's nothing. So what does that mean? It means our first, most basic question led us to a dead end. It's pretty much a tie. Just knowing if a company has debt or not, well, it doesn't really give you an edge as an investor. So we've got to dig deeper. All right, on to our second clue. If just having debt doesn't matter, maybe what really matters is the trend, the direction the debt is heading. Think about it this way. What if it's not about if they have debt, but whether that debt is going up or down? Are companies that are paying off their loans a better bet than companies that are piling more on? This feels like a much smarter question. Let's see what the numbers say. Okay, now this next table is a little busier, but trust me, a huge piece of the puzzle is hidden right in here. We're basically looking at 4 different situations for a company's debt trend. And boom, right away, we have a clear winner. Look at companies with decreasing debt. That initial $10,000, it grows to almost $18,000 over 5 years. And that just makes sense, doesn't it? A company getting its financial house in order by paying down what it owes? Yeah, the stock price should reflect that. It's a sign of health. But this is where things get really, really weird. I want you to look at that bottom category, companies that went from having no debt to suddenly taking on debt. Now, your first instinct is probably that this is a terrible sign, right? A bad move. Well, get this. In the very first year after taking on that new debt, these stocks jumped a whopping 17% on average. That's actually the best first-year return of any group we've looked at. It seems like the market sees this and thinks, oh, they must be gearing up for a big expansion. This is great. But that sugar rush doesn't last.
Fast forward to year 4, and those same high-flying stocks drop by an average of 9%. Ouch. All that early optimism just fizzles out. Their performance, as the author puts it, becomes dreadful.
So what's the takeaway here? It's a trap. That initial 17% pop is incredibly tempting. But over the full 5 years, this group is the absolute worst performer. Your 10 grand only grows to about $14,400. It's a classic story of short-term hype leading to long-term disappointment.
Okay, so we're getting closer. We now know that decreasing debt is a really good sign, and going from no debt to some debt is a trap. But there is one final critical piece to this puzzle that we need to add, and it's all about the size of the company. So let's ask the next logical question. Does our new rule, decreasing debt is good, work the same for every company? I mean, does it make a difference if we're talking about a massive, large-cap giant or a smaller, scrappier company? This is the final layer we need to peel back. All right, this is it. This is where it all comes together. We've got 2 tables here. On the left, you've got companies with increasing debt, sorted by size. On the right, the same thing, but for companies with decreasing debt. And since we already know decreasing debt is where the magic is, let's zoom in on that table on the right. And this chart just lays it all out crystal clear. It's not even a competition. The small cap companies, those are the smaller public companies, the ones that are actively paying down their debt, they just blow everything else out of the water. That $10,000 investment, it more than doubles. We're talking over $22,500. Honestly, if you remember one thing from all of this, let it be this. Small companies that are showing the financial discipline to pay down their debt have historically delivered the best performance, by a long shot. That combination is just incredibly powerful. So we've waded through all the numbers, we've followed the clues. What's the simple, ultimate guideline we can walk away with? Let's boil it all down. Okay, so what can you actually do with this information? Well, it boils down to this. First, check the debt trend. You're looking for companies with decreasing long-term debt. That's the signal. Second, check the company size. Zero in on the small cap stocks. And when you find that winning combination, small cap stocks that are actively paying down their debt, well, the data shows that's where the best 5-year returns have been. So now that you know the secret, how are you going to look at a company's balance sheet from now on? It's pretty incredible, right? We started with this simple idea, debt is bad, and ended up with something so much more specific and powerful. It's not just if a company has debt, it's about the trend and it's about the size. Something to definitely think about. If you spent any time at all looking at stocks, you've definitely run into the PE ratio. It's maybe one of the most famous metrics in all of investing. And for the longest time, the conventional wisdom about it has been really, really simple. Yeah, the thinking basically went like this. A high PE ratio was like a badge of honor for a stock. It meant this was a great company, everyone wanted in, growth was going to be huge. You know the drill. So a higher number meant a better company. Simple as that. But what if, and this is a big what if that entire idea is not just a little bit wrong, but completely and totally backwards? What if chasing those high-flying, high-quality stocks is actually the very thing that's been hurting your portfolio's performance? Well, that's exactly what we're about to find out. Okay, before we get into the myth-busting, let's do a super quick refresh, just so we're all on the same page. The PE ratio is just the company's current stock price divided by its yearly earnings. The easiest way to think about it is, it's the price you're paying today for every single dollar of profit the company makes. All right, let's get to the main event. It's time for a head-to-head showdown. In one corner, we have the crowd favorite, the popular kids, the high PE stocks. And in the other corner, the overlooked underdogs, the low PE stocks. Let's see what the data actually says. So here's how we're setting up the match. We've got Team High PE, which is all the stocks with a PE ratio above the market's historical midpoint, which is roughly 17. And then we have Team Low PE, which is, you guessed it, all the stocks below that midpoint. The question is, which team actually wins over the long haul? And the first results are in. This chart shows what would happen to a $10,000 investment over 5 years. The top row is our high PE team, and the bottom row is the low PE team. Just look at the difference by year 5. I mean, the results are pretty staggering, right? After those 5 years, the low PE portfolio grew to almost $18,000. The high PE stocks? They barely cracked 15.8. That's a difference of over $2,000. The supposedly worst stocks actually made investors a whole lot more money. So there you have it. Myth busted. Round 1 goes without a doubt to Team Low PE. That old idea that a high PE means better returns, the data says, nope, not even close. But believe it or not, the story gets even more interesting from here. Okay, so we've established that a low PE number is good. Check. But what about the direction it's heading? Does it matter if a stock's PE is on the rise or if it's falling? It's the logical next question, right? A falling PE can mean the stock's price is getting cheaper, or it could mean the company's profits are growing faster than its price. So you have to wonder, is a PE that's trending downwards an even more powerful buy signal? Well, let's look at the data. This table compares the two scenarios. The top line shows stocks where the PE was going up over time. The bottom line shows stocks where the PE was going down. And once again, the difference is pretty darn clear. It turns out a falling PE trend is like a powerful tailwind for your investment. That same $10,000 grew to over $17,000 in the falling PE group, but only hit about $15,600 in the rising group. So, lesson number 2, we don't just want a low PE, we want one that's getting even lower. All right, so we have 2 major clues now. Look for a low PE and look for a falling PE. But there's one more piece to this puzzle, and frankly, it's the one that acts like an absolute supercharger on performance. The researchers decided to slice the data one more way, by company size. You know, what investors call market capitalization, or market cap. And when they combined the low PE factor with one particular size of company, well, the results just went completely off the charts. And here it is, the big reveal. This table breaks it all down by small, medium, and large companies, each sorted by their PE. Now, look at the mid and large caps. A low PE definitely helps a bit. But now, look at the very top section for the small cap companies. The results there are just in a whole different league. $21,418. Let that sink in for a second. That initial $10,000 investment more than doubled in 5 years. This one specific category just absolutely crushes every single other strategy we've looked at. So the secret ingredient is finally revealed. The data is about as clear as it gets. The most powerful performance driver by far is the combination of a low price-to-earnings ratio with small-cap stocks. Okay, this has been a fascinating look at the data, but how do we actually use this information? How do we turn all these numbers and charts into a simple, practical strategy? Let's distill it all down into an action plan. So here it is, your PE buy checklist. It's just 3 simple steps. First, target stocks with those low PE ratios, generally below that historical median of about 17. Second, give extra points to companies where that PE is also trending down year over year. And third, to really add that potential supercharger, focus your search on small cap companies. But look, any good strategy isn't just about buying, right? That's only half the battle. It's just as crucial to have a clear signal that tells you when it might be time to take your profits and sell. And the research actually gives us a pretty simple rule of thumb for this. Consider it a sell signal if a stock's current PE ratio climbs higher than its own peak from the last 3 years. The data showed that stocks hitting that mark tended to really underperform over the next year. It's a great little warning sign. And one last really important piece of advice to avoid what they call value traps. Not all cheap stocks are good buys. The real gems are often companies that used to be popular with high PEs but have recently fallen out of favor. You want to be careful with stocks that have always been cheap. There's usually a pretty good and not so good reason for that. So let's just quickly recap the whole game plan. The data is clear. Low PE beats high PE. A falling PE trend gives you an extra powerful edge. And the ultimate winning combination, the one that blew everything else away, is a low PE ratio paired with a small cap stock. And that brings us to the final provocative question you should probably ask yourself. Take a look at your own portfolio. Which of those popular, well-loved, so-called high-quality stocks, the ones with the high PE ratios, might actually be the very ones that are weighing down your returns? Based on this data, it's a question that is absolutely worth asking.
All right, let's talk about one of the most debated metrics in all of investing, the price-to-sales ratio, or PSR for short.
Some investors swear it's the key to finding hidden gems, while others think it's completely useless. So what's the real story? Well, we're going to dive into the data and find out.
And to get us started, check out this quote from the respected investor James O'Shaughnessy. He called the price-to-sales ratio the king of value factors. Wow. I mean, a title like that really makes you stop and wonder what he saw that so many others might be missing.
And that really gets to the heart of the debate, doesn't it? On one hand, is the PSR a total game changer, the greatest thing since sliced bread for finding value? Or on the other hand, is it a flawed metric about as helpful as trying to drive through a snowstorm with your headlights off? We're going to follow the data and settle this.
So let's start piecing this puzzle together, and the very first piece is just figuring out what the price-to-sales ratio actually is.
Okay, so here's the official textbook definition for you. The price-to-sales ratio is what you get when you take a stock's current price per share and divide it by the company's annual sales per share. The math is simple enough, but what does that number really tell us as investors?
Let's just put it in plain English. The PSR answers one really simple question. For every single dollar a company makes in sales, how much is the market, that's investors like you and me, willing to pay for it? A lower number is better because it means you're paying less for those sales.
Now that we know what it is, let's get to the really good stuff. It turns out the data points to a really simple rule of thumb, a kind of magic number that works as a fantastic starting point.
And here it is. Look for companies with a PSR below 1.0. The source material we're looking at calls this the line in the sand where the tasty morsels reside. Think about it. A PSR below 1 means you are paying less than $1 for $1 of a company's sales. Sounds like a bargain, right?
And hey, this isn't just some gut feeling, there is hard evidence behind it. Take a look at this study. It followed almost 900 stocks over a 15-year period. You'll notice two main rows in the table, one for stocks above the median PSR and one for those below. The group below that line consistently, year after year, delivered higher returns. So let's see what that looks like in real money.
Okay, let's say you invested $10,000 in a group of stocks with PSRs above 1.0. After 5 years, your investment would have grown to just over 15 grand. Not bad at all. But what if you had put that same $10,000 into the stocks with PSRs below 1.0? You would have walked away with over $18,000. That's a huge difference, and it really shows you the power of this one simple rule. But you know what? We can do even better. That 1.0 rule is a fantastic starting point, but the data actually shows us a few more layers we can peel back to really refine our search for those winning stocks.
It turns out, it's not just about the PSR number itself at any given moment. The trend, which way it's heading, matters a lot. Take a look at the data here. It compares how stocks with an increasing PSR performed against those with a decreasing PSR. That direction, that trend, is a really crucial signal. So here's the key takeaway. A decreasing PSR is a bullish sign. It suggests either that the company's sales are growing faster than its stock price or that the stock is just getting cheaper relative to its sales. Either way, it means the market hasn't quite caught on yet, and as the data shows, this group tends to outperform over the long run.
And now for the final piece of our analysis. What happens when we mix the PSR with a company's size? It's market capitalization. Now, I know this table looks a little busy, but if you look closely, it reveals the ultimate sweet spot for getting the best returns. You can see how it breaks down performance for small, mid, and large cap stocks, each divided by their PSR.
But let's just boil it all down to a simple formula. The data is crystal clear. Small cap companies, combined with low price-to-sales ratios, deliver the best results, period. And it kind of makes sense, right? These are often younger, faster-growing companies that are still flying under the radar of the big institutional investors. And just look at this number. That same $10,000 investment we talked about earlier, when focused specifically on small-cap stocks with low PSRs, it more than doubled to over $21,000 in 5 years. This was the single best-performing group in the entire study. Absolutely incredible.
Okay, now before you get too excited and run off to find these low PSR stocks, we have to talk about the warnings. Like any single metric, the PSR has some serious blind spots, and if you ignore them, you could get into a whole lot of trouble.
Here is the single biggest trap you need to watch out for. A company can have fantastic sales and a tiny stock price, which gives it a great-looking low PSR, but at the same time, it could be absolutely drowning in debt. See, the PSR tells you nothing about liabilities. A company can sell a ton of products and still go bankrupt.
This second major trap is ignoring industry context. A good PSR is not a universal number. For example, the average PSR for an alternate energy company is over 57. For an airline, it's less than 1. This just means you can't compare a solar panel company to an airline using PSR alone. You have to compare it to other solar companies. It's all relative.
So we've seen the power of the PSR and we've seen the pitfalls. How do we put all of this together in a way that's actually useful? Well, let's synthesize everything we've just learned into a simple, practical checklist you can use.
Here it is, your 5-point checklist. Number 1, start by looking for PSRs below 1.0. 2, you should favor companies where that PSR is trending downward. 3, focus on small cap stocks because that's where the data shows the biggest potential is. And then, critically, the 2 safety checks. Number 4, always check the company's debt. And number 5, always compare a company's PSR to its direct competitors. So there you have it. The price-to-sales ratio isn't a magic bullet, but it's far from useless. When you use it correctly, with the right context and these important safety checks, it can be an incredibly powerful tool for uncovering hidden value. We've given you the rules from the data. The only question left is, what undervalued companies will you find?
You ever have one of those moments you spend hours, maybe days, doing careful research on your investments, only to watch a friend get better returns picking stocks with like a dartboard? It's a crazy, frustrating feeling. Well, the author of our source material had that exact thing happen back in 1979. He watched his office mates' totally random picks just crush his own carefully chosen ones. And that sent him on a journey to figure out what was really going on.
So that's the big question, isn't it? Could it be that one of the most trusted rules in investing is, well, wrong? We're going to follow along as he puts a big one, return on equity, to the test. And trust me, the results are probably not what you're expecting. Okay, let's get into it.
First up, we got to understand why everyone fell in love with this metric in the first place. For decades, return on equity, or just ROE, has been treated like this golden rule for finding amazing companies.
So what is it exactly? Well, basically, ROE tells you how much profit a company is squeezing out of the money its shareholders have put in. The idea is pretty simple. If profits are going up faster than the company's net worth, management must be doing something right. It's supposed to be the thing that separates the winners from the losers.
And of course, there's a magic number. For years, the pros have been saying, you got to look for a company with an ROE of at least 15 to 20%. That was the benchmark, the sign of a real quality investment.
Now, this is what's so powerful about it. ROE isn't just about what a company did last year. It's seen as a predictor of what it's going to do. The thinking is, a company can't really grow its earnings faster than its ROE without doing some financial gymnastics, like taking on debt. So it's seen as this fundamental speed limit on growth.
But no single metric is perfect. And the weaknesses in ROE, well, that's where our story really starts to get good. Let's take a look at where the first cracks in the armor start to show up.
And here they are. A company can actually game its ROE by taking on a ton of debt. How? Well, debt reduces shareholders' equity. That's the bottom number in the ROE equation. So a company can look super profitable and efficient, but actually be drowning in risk. A high ROE isn't going to save you if the economy tanks and you can't pay your bills.
Okay, so the fix seems obvious, doesn't it? Just find a company with that awesome 15–20% ROE, but also make sure it has very little debt. Boom, perfect formula. That has to be a winning stock pick, right? Well, not so fast.
And this is where we get to the heart of it all. The author decided, you know what? I'm going to test this. He crunched the numbers on over 900 companies across 15 years to see if this wisdom actually worked. And what he found was, well, it was a shocker.
I mean, you can just feel it in this quote. This wasn't some tiny little statistical blip. The data told a story that was the complete opposite of what pretty much every investing textbook says.
So here's a peek at the raw numbers. The median ROE for all the companies in the study was about 13.4%. The study then looked at what happened to the stocks above that number versus the stocks below it over 5 years.
And check this out. It's wild. If you'd put 10 grand into the high ROE stocks, the ones everyone says you should buy, you'd have about $15,700 after 5 years. Pretty good. But if you'd put that same 10 grand into the low ROE stocks, the supposed losers, you'd have over $17,400. The underdogs didn't just win, they won by a lot.
Now, at first, the author thought he must have messed something up, but he did some digging and found out he wasn't the first person to see this. Another investor, James O'Shaughnessy, found that high ROE stocks are basically a coin flip. They only do well about half the time. So this wasn't a fluke. It was a pattern.
So what in the world is going on here? I mean, this just seems to defy all logic. Let's dig a little bit deeper into the numbers and see if we can figure this out.
All right, so you might be thinking, okay, maybe the level of ROE doesn't matter, but what about the trend, right? A company whose ROE is going up should be a better bet than one where it's falling. That makes sense.
So, they looked at that exact question. They compared the 5-year returns for companies with an increasing ROE against those with a decreasing ROE. Let's see what the data has to say about that.
And the result? It barely made any difference at all. $10,000 grew to about $16,700 for the improving stocks versus $16,400 for the declining ones. The author's one-word summary for this finding really says it all. Yawn. So clearly the trend isn't the secret sauce either.
Okay, one last try to save this rule. Maybe ROE just works differently for small cap stocks versus the big guys, like Apple or Amazon. You know, does the size of the company, its market cap, change the story at all?
Now, this table looks a little more complicated, I know, but this is where we finally find some real nuance. It breaks down all the performance numbers based on whether a company is small, medium, or large, and whether its ROE is high or low for its group.
All right, let's just boil this down. First thing, small cap stocks were the best performers overall, which is something a lot of market research finds. Second, for the bigger companies, mid and large caps, the weird pattern holds true. The stocks with low ROE actually did better. But here's the one tiny exception. For the small cap stocks, having a high ROE did lead to slightly better performance. It's the only place the old rule worked, and even then, just barely. So, we've kind of busted this huge, long-held myth. What's the takeaway for you, the investor? How should you actually think about ROE from now on?
Here's a much smarter checklist based on what the data actually tells us. First, know what ROE is. But second, recognize that historically stocks with below average ROE have been the winners. Third, don't waste your time worrying if ROE is going up or down. And finally, remember that company size, especially being a small cap stock, can be a huge factor in performance.
And that really brings us to the final thought here. For decades, investors were told that a high ROE was the ultimate sign of a great company. But as we've just seen, the data tells a much more complicated story, and often the complete opposite. It really makes you wonder, doesn't it? What other golden rules of investing are just myths waiting for someone to come along and bust them?
Have you ever wished there was a simple clue in the stock market, something hiding in plain sight? Well, today, we're diving into a powerful signal that's often overlooked, a company's share count. It sounds kind of technical, but trust me, it can tell you a whole lot. So let's kick things off with a pretty bold question. What if you could actually measure a company's confidence in its own future with just a single number? It sounds a little out there, but it turns out you just might be able to. And that number? It's their share count.
All right, let's get our terms straight. The metric we're talking about is shares outstanding. Basically, this is all the stock a company has out there that's held by investors. You know, everyone from big institutions to people like you and me. But here's the most important part. This number is not set in stone. It can change.
And that change really sends companies down one of two very different paths. On one hand, they can buy back their own shares. Think of it like a pizza. They're taking a pie with 8 slices and turning it into one with 6. Each slice gets bigger. Or they can do the exact opposite and issue new shares, which is like cutting that same pie into 10 smaller slices.
This brings us to the billion-dollar question, right? Does messing with the number of slices actually change how good the pie tastes? In other words, does changing the share count really make a difference to a stock's performance? Well, let's see what the data has to say. And wow, the data here is pretty incredible. What you're looking at summarizes a 5-year study that tracked stocks based on just one thing. Did they shrink their share count or did they grow it? The difference in performance between the two is just staggering. Okay, let's start with the winners. Let's say you put $10,000 into companies that were aggressively buying back their own stock. We're talking reducing their share count by 10 to 15%. 5 years down the road, you'd be looking at almost 25 grand. Not bad at all. Now, for the other side of the coin, what about the companies that did the exact opposite?
the ones that issued a lot more shares. Well, that same $10,000 investment would have grown to just under $16,000. I mean, that is an absolutely massive difference in performance, and it all comes down to this one simple signal. And this quote just nails why that is. Issuing more shares is all about dilution. Just like with that pizza, every time the company adds more slices, your individual piece gets smaller. Your ownership stake is literally being watered down. All right, so let's dig into that first path, the one that made all the money, the power of the buyback. This is where a company's actions are screaming confidence.
So why do they do it? Well, first off, it is a huge vote of confidence. Management is basically telling the world that the best investment they can possibly find is their own company. It's often way less risky than trying to buy another company, and the math is just beautifully simple. Fewer shares on the market means the earnings per share, or EPS, goes up. And when earnings go up, the stock price usually isn't far behind.
Now, one of the really interesting ways companies pull off these big buybacks is through something called a Dutch auction. It sounds super complex, but it's actually a pretty clever way to buy back a ton of shares all at once and do it efficiently. Okay, so here's how it works, step by step. First, the company says, hey, we want to buy back this many shares and we're willing to pay somewhere in this price range. Then any shareholder who wants to sell offers up their shares, saying what price they'll accept. Then the company figures out the one single price that lets them buy all the shares they wanted. And here's the cool part. Everybody who offered to sell at or below that final price gets paid that single higher price.
So this leads to the big question for you, the investor, if you own the stock. Should you take the deal? Should you sell your shares in the auction?
Well, the numbers here are pretty much screaming the answer. A study found that in 95% of these cases, the stock price actually drops below what the company paid in the auction, usually within about 3 months. And we're not talking about a little dip either. The median drop was 13%. So the strategy seems pretty obvious, right? Sell your shares in the auction, and hey, maybe you can buy them back cheaper later on.
But hold on, there's a really important catch here, and it's all about size. As you can see from the chart, when the buyback is huge, the price tends to fall afterwards. But for smaller buybacks, you might actually see a little price pop. Size definitely matters here.
Okay, let's flip this thing around and look at the other side of the coin. The dilution effect. This is what happens when a company decides to issue more shares.
So how does the market react? Well, it's usually not pretty. The source material had this fantastic analogy for it. The stock price sinks, sometimes like a submarine with a hole in it. I mean, what a great visual, right? And it makes perfect sense because every single shareholder knows their piece of the pie is about to get smaller.
And this reaction tends to follow a really predictable pattern, kind of like what you see on this chart. The stock price typically takes a nosedive right after the announcement, forming the left side of a U. Eventually, it finds a bottom and starts that slow climb back up. And here's a little nugget of information for you. That bottom, the very lowest point of that U-shape, often hits in about 2 weeks. Now, for a savvy investor, that predictable dip could look like a pretty interesting buying opportunity.
So the rule seems pretty simple, right? Buybacks are good, issuing new shares is bad. But you know, in the stock market, there's always a twist. And in this case, the twist is all about company size. This data takes that same information, but it slices it another way, by the company's market cap, how big it is. And when you do that, things get weird, like really counterintuitive.
So check this out. For the little guys, the small cap stocks, the rule works perfectly. They do best when they shrink their share count. No surprise there. But look at the big guys, the large cap stocks. It's totally backwards. They actually performed better when they increased their number of shares. Crazy, right? Your $10,000 would have grown more if they issued shares than if they bought them back. For the biggest companies, this just flips the whole idea on its head. But okay, even with that fascinating exception for the mega companies, the big picture lesson here is still incredibly powerful. When you look at the entire market, the trend is crystal clear. A company reducing its share count is a bullish signal. As the source says, the larger the share buyback, the better the performance. So what's the big takeaway from all this? It's that this one little number, the share count, is packed with a ton of information. It's a signal of what management is thinking, it's a hint about future performance, and it's a clue to their strategy. So the next time you see a company making a move with its shares, you'll know what's really going on behind the scenes. You can ask the right question. What is this number really trying to tell me?
Hey everyone, and welcome. If you've ever stared at the stock market and just wondered, what actually works? Well, you're in the right place. Today, we're going to dig into some really fascinating data that ranks investment strategies by how they perform in the real world. So let's dive in. I mean, it's the million-dollar question, isn't it? It's what every single investor is after. That secret formula, that one key thing that helps you pick a stock that's going to crush it. But where do you even start? Because as soon as you start looking, you're hit with this total alphabet soup of financial metrics. PE, ROE, PSR. It's just a dizzying array of numbers and ratios, and everyone's telling you they're all important. But which ones actually move the needle? Well, today, we're going to cut right through all that noise. Forget guessing. We're going to look at the hard data from a really detailed study that tracked dozens of these strategies to see which ones really deliver the goods. So here's our game plan. First, we'll look at the one-year sprint, the best strategies for short-term holds. Then we'll stretch it out to a 3-year horizon. After that, we'll see what wins in the long haul with the 5-year marathon. And finally, we'll wrap it all up into your investing playbook.
All right, first up, the one-year sprint. If you're looking for strong performance over just a 12-month period, what does the data say you should be focused on?
And boom, right away, a really clear winner emerges. Strategies that are based on a company's book value, which, is basically just the company's assets minus its liabilities, they take 3 of the top 5 spots. It seems like in the short term, finding companies that are just plain cheap compared to their net assets is an incredibly powerful way to go. And the potential here is huge. The number one strategy, which was focusing on small cap stocks with a falling price-to-book ratio and a rising return on equity, would have turned a $10,000 investment into over $14,000 in just 1 year. That's a massive 41% return. But, and this is super important, the author of the study gives us a big warning. That amazing number one strategy, turns out it was only based on 77 trades. That's a pretty small sample size, which means the result might just be a fluke. It's a great reminder for all of us, right? Always check the context behind the numbers. Okay, so let's zoom out a bit. Let's extend our view to the 3-year horizon. If we give our investments a little more room to breathe, do the same strategies keep winning? Or does a whole new picture emerge? Now, looking at the 3-year data, we see some familiar friends, right? Book value and cash flow strategies are still performing like absolute champs. But, hang on a second. Look at number 4. Companies cutting their dividends. Now, that sounds like terrible news, doesn't it? So what on earth is it doing on a list of winning strategies? But first, just check out the power of a little bit of patience. The top strategy over 3 years would have turned that same 10 grand into more than $17,000. Time is clearly a powerful amplifier for these kinds of value strategies. Okay, so here's the secret sauce behind that weird dividend cutting strategy. It is all about timing. The data suggests you don't buy the second the bad news breaks. No. Instead, when a company cuts its dividend, the stock often gets hammered. The strategy is to wait for it to hit rock bottom. Then you go fishing for the stock, positioning yourself to catch that rebound. It's a classic contrarian play, and clearly it can pay off big time. And that brings us to the main event, the 5-year marathon. This is where real, serious, long-term value gets created. So, what does the data reveal as the undisputed long-term champion? And here it is. We've got a surprise winner, folks. After 5 years, the top-performing strategy isn't based on a classic value metric like book value or PE at all. It's investing in companies that are aggressively buying back their own stock. And look, our other top performers, book value, those dividend cuts, cash flow, they're all still right there, hanging out at the top. I mean, just look at this. The power of this long-term strategy is absolutely stunning. A $10,000 investment would have ballooned to almost $25,000 over 5 years. That's a 146% return. It just goes to show you the incredible potential of a patient, data-driven approach. So why is this so powerful? Well, think about it. A huge share buyback is one of the strongest signals management can possibly send. They're basically screaming from the rooftops, we believe our stock is undervalued, and we are so confident in our own future that we are putting our money where our mouth is. It's a massive vote of confidence. Okay, so we've waded through all this incredible data.
What does it actually mean for you? How can we turn all these insights into a simple, practical playbook for our own investing?
If there's one thing you take away from all this, it's this. Your timeline is your strategy. It dictates everything. For short-term sprints, the data points to old-school value metrics, like a low price-to-book ratio. But for long-term marathon wealth creation, a powerful signal of company confidence, like a major share buyback, takes the crown.
So, let's just boil this all down into 3 simple principles for your playbook. Number 1, define your time horizon. Are you sprinting or are you running a marathon? Number 2, focus on value metrics. Don't forget the classics. Finding cheap companies based on their book value is a consistently powerful move. And number 3, always check the context. A number on a screen is meaningless until you understand the story behind it.
And so that brings us to the final question, and this one's for you. Armed with all this performance data, whether you see yourself as a sprinter or a marathoner, what's the first thing you're going to look for in your next potential investment? Thanks so much for joining me.
Have you ever wondered if there's, a secret blueprint for finding a stock that's about to take off? Well, today, that's exactly what we're doing. We're going to go on an investigation, sifting through the evidence from thousands of companies to build a complete profile of a potential winner. So, let's crack this case file open. Right off the bat, our lead investigator for this analysis, Thomas Bulkowski, gives us a great little piece of wisdom. It's funny, of course, but it's also a fantastic reminder that trying to double your money in the market is absolutely no joke.
Right, so folding your money in half is definitely not the plan here. The real goal is to see if we can uncover a kind of blueprint. We're going to dig into a ton of data, looking for those hidden patterns, the common traits of stocks that actually did it, that actually doubled in price.
So we are absolutely treating this like a detective case. We're going to examine all the clues, the financial fingerprints these top-performing stocks left behind. Each piece of evidence is going to add another piece to the puzzle, helping us build out that complete profile of our target.
Okay, but before we dive in any deeper, we need a really important warning, and this comes straight from the source material. This is not a magic formula. Let me say that again. It's not a guarantee. We're just identifying common traits. Some stocks that fit this profile perfectly will still fail. This is all about stacking the deck in your favor, not eliminating the risk entirely.
All right, with that out of the way, let's get into it. Every good investigation starts with the basics, right? So first things first, we're going to look at the simple stuff. How much did these stocks cost, and just how big were the companies behind them?
So this chart here breaks down the starting price for the stocks that doubled versus all the others. Now, I know the details might be a little small, but don't worry about that. It's the overall pattern that really matters, and that pattern is crystal clear. The stocks that doubled almost always started at a much lower price point. Let's make that even clearer.
So here is the key takeaway. Get this. A whopping 76% of the stocks that doubled were priced under $20 when they began their climb. Compare that to the stocks that didn't really go anywhere. They tended to be more expensive, hanging out in that $15 to $35 range. The evidence really suggests that cheaper stocks just have more room to run.
And check this out. This visual really nails the size factor. An incredible 65%, almost 2/3, of the stocks that doubled were small cap companies. We're talking valued at less than $1 billion. And it kind of makes sense, doesn't it? It's a whole lot easier for a little speedboat to double its speed than it is for a giant oil tanker.
Okay, so we've got our basic profile down. They tend to be lower priced and smaller companies. Now it's time to go a level deeper. We're pulling out the magnifying glass and digging into the financial DNA, those key ratios that really separate the winners from the losers.
Now this is really the heart of the financial investigation. It's looking at a few key valuation metrics. Basically, these numbers are just a fancy way of asking, how expensive is this stock compared to its sales, its earnings, or its cash flow? And in every single case, the pattern is just undeniable. The stocks that went on to double had lower numbers. They were just fundamentally cheaper, which suggests they were undervalued right before they took off.
All right, now for my favorite part of any investigation, the twists. This is where things get really interesting, because some of the most powerful clues we're about to see fly directly in the face of what a lot of people consider common investing wisdom. Okay, here's a big one. Dividends. Everybody loves dividends, right? That steady income, that check in the mail. The conventional wisdom says it's the sign of a healthy, mature company. But is that what we find when we look at these high-growth stocks?
Well, the evidence says, nope,
Not at all. Almost 60% of the stocks that doubled paid zero dividends. And the thinking here is pretty simple. Instead of giving you that cash, these companies are plowing every single penny right back into the business to grow even faster.
And here's another curveball for you. You'd think, hey, a company is spending a ton of money on new buildings, new factories, new projects. That's got to be a good sign, right? It means they're growing. But does the data actually back that up?
Incredibly, we see the complete opposite. Half of the stocks that doubled had actually cut back on that kind of spending. Meanwhile, the stocks that went nowhere were the ones more likely to be spending more. It kind of suggests that the winners had maybe already done their building and were now just focused on cashing in.
You know, just as important as knowing what to look for is knowing what to ignore. And this investigation found a few red herrings, things people sometimes obsess over, like long-term debt or the number of shares a company has. Well, they turned out to be dead ends. They just weren't reliable clues.
Okay, this is the moment we've been working towards. We have gathered all the evidence. We've looked at the basic stats, the financial DNA, and all the surprising little behaviors. Now, it's time to put it all together and create our final composite sketch of a potential doubler.
And here it is, the complete 9-point profile. We've already talked about a lot of these clues, right? A price under $20, a small company, decreasing capital spending, no dividend. This checklist also adds in some specific targets for those valuation ratios we talked about, like a price-to-sales ratio under 1.0. This is it. This is the blueprint we set out to find.
So, we have the profile. But here's the billion-dollar question. Does it actually work? I mean, how much of a difference does using this checklist really make in your chances of finding a winner? Well, the results are pretty staggering.
First, let's set the baseline. If you just picked a stock completely at random from this study, your odds of it doubling within 5 years were about 1 in 4, 26%. You know, not terrible, but we can do better.
Now, look what happens when you only focus on the stocks that ticked all 9 of those boxes on our checklist. The probability of finding a winner jumps from 26% all the way to 67%. I mean, just think about that for a second. You go from a 1 in 4 shot to a 2 in 3 shot. That is an absolute game changer.
So, we've built our profile, we've seen the incredible results, but just like we started with a warning, we have to end with a serious dose of reality, because the path to doubling your money is never, ever a straight line.
Please let this one sink in. Even the stocks that were ultimately massive winners got hammered along the way. In any given year, they could lose between 18 and 26% of their value. This journey requires some serious patience and a strong stomach for volatility. It is not a smooth ride.
So there you have it. The case file gives us a map. It dramatically improves our odds of finding where the treasure might be buried, but it doesn't pave the road for you, and it certainly doesn't eliminate all the risks. So the real final question, the one you have to ask yourself, is this. Knowing the potential rewards, but also knowing the rough journey it takes to get there, is this a map you're truly willing to follow?
All right, let's talk about something every single investor dreams of, cracking the code on 10 baggers. We're going to set aside all the gut feelings and just dive headfirst into the data to find out what these incredibly rare, high-performing stocks really have in common.
You know the feeling, right? We've all been there. You're staring at a stock chart that looks like a rocket launch, and you point to the very bottom and think, ugh, if only I'd known, I should have bought right there. It's that classic 20/20 hindsight. But what if we could get a little better with our foresight? So first, let's just get on the same page. What is a 10-bagger? It's simply a stock that delivers a 900% gain. Or put another way, it grows to 10 times what you originally paid for it. It's the absolute home run of investing. And you know, that really brings us to the million-dollar question, doesn't it? How do we spot one of these things before it goes to the moon? Is there a pattern? Some kind of hidden signature? Well, that is exactly what we're here to figure out. Now, our whole analysis today is based on a really detailed study. It tracked 163 different stocks that all managed to become 10-baggers between 1992 and 2007. So this gives us a really solid historical set of data to see what made them tick. So first up, let's look at the anatomy of their climb to the top. You know, how much did these stocks even cost when they started? And how long did it actually take them to get there? The answers might not be what you expect. Okay, so first things first, price. I think a lot of common wisdom tells you to kind of avoid the bargain bin stocks, but what does the actual data say?
Where's the starting line for these marathon runners? So check this out. What's absolutely fascinating here is just how many of these were low-priced stocks. I mean, a massive 55%. That's more than half of these future giants started out trading for under $5 a share. Then you've got another 34% between $5 and $10. Very, very few started out as expensive, well-known names. So the big takeaway here is this. The prime hunting ground for these incredible performers was, overwhelmingly, in that single-digit price range. The median starting price in the whole study was just $4.19. Okay, so they often start out cheap. Got it. But is this a get-rich-quick kind of deal? I mean, how long are we actually talking about for that tenfold return to happen? Yeah, this is almost never an overnight success story. While a very lucky 8% did hit that 10x mark within a year, the path usually gets a lot longer. You see 17% needed 2 years, and then the biggest groups needed 4 or even a full 5 years to finish that climb. And this really hammers home the most important virtue in all of this: patience. That single biggest group, 41% of these stocks, needed the full 5 years to get to that 10x milestone. This is a long-term game, for sure. All right, let's switch gears to the financials, because this is where we're going to start busting some of the biggest myths about what a perfect stock is supposed to look like before it really takes off. Okay, myth number 1, a great company has to be a profitable company. The reality? Well, it's pretty shocking. A staggering 64% of these future 10 baggers were actually losing money the year before their huge run began. Now compare that to your average typical stock, where 62% are already profitable. It's completely backward. So what about sales? I mean, you've got to have explosive sales growth, right? Nope. The median 10-bagger had sales growth of just 0.5%. That's basically flat. Meanwhile, your average stock was growing sales at over 6%. So the 10-baggers were actually massive underperformers on this metric. All right, well, what about investing in the future? You know, pouring money into new factories, new equipment. It's the exact opposite. 59% of these companies were decreasing their capital spending. They were tightening their belts, not expanding. While the benchmark companies were much more likely to be ramping up their spending. And hey, forget about getting paid a little something while you wait. Only a tiny 13% of these future 10-baggers paid out a dividend. They were putting every single penny back into the business, not giving it back to shareholders. Your typical company was more than 3 times as likely to pay one. So, if it's not profits, not sales, and not investment, what is the key? Well, let's talk about valuation. This number right here is one of the biggest clues the whole study uncovered. 56%. That's how many of these 10-baggers had a price-to-sales ratio below 1. Now, this is a really key metric for companies that aren't profitable yet. It basically means the entire stock market value of the company was less than 1 year of its sales. In other words, they were often just plain cheap. Okay, so we've got a financial picture of a company that's often cheap, unprofitable, and actually cutting costs. But where do we even find these things? What size are they? And what kinds of industries are they in? Well, the answer is overwhelmingly in the small cap space. A huge 77% of all the 10-baggers in this study were small companies. And that makes sense, right? It's a whole lot easier for a small speedboat to change course and hit the gas than it is for a giant oil tanker. And during this specific time frame, from 92 to 07, these opportunities were really concentrated in just a few industries. Tech was absolutely massive, semiconductors, the internet, all that equipment, but you also saw it in more cyclical areas like home building and even alternate energy. Okay, so we've looked at price, we've looked at patience, financials, and sectors. Let's try to put all these clues together into one final unified profile of what a historical 10-bagger looked like. So let's put it all together. The typical 10-bagger from this era was a small cap stock, usually trading under $5. It was often losing money, had pretty weak sales, and was even decreasing its investments. It almost never paid a dividend, but, and this is a big but, it was very, very likely to be cheap on a price-to-sales basis. When you just look at this list, you realize you're staring at a profile that defies almost everything we're taught about what a quality investment should be. But this all leads to the most important question, doesn't it? This data is from a very specific period in market history, a period dominated by the dot-com boom and everything that came after it. So what do you think? Does this completely counterintuitive profile still work today? Or have the characteristics of the market's biggest winners totally changed?
Well, that's the puzzle for today's investor to solve. We've all heard the stories, right? That one investment that just takes off, turning a few bucks into a small fortune. But are those incredible stock runs just a matter of pure dumb luck? Or is there a secret blueprint they all follow? Well, in this explainer, we're going to pull back the curtain and look at the secret life of a monster stock. So let's start with the big one. You've probably heard this term thrown around before, a 10-bagger. It sounds kind of like weird investing jargon, but what it really describes is something incredibly simple and incredibly powerful. It's the kind of investment that can genuinely change your life. Yep, that's it. You put in $1,000, you get $10,000 back. It's the grand slam, the home run every single person dreams of hitting. But here's the thing, finding one is only half the battle. And this is the part that trips everyone up. You can find an amazing company, a future giant, and its stock will do absolutely nothing for years. The real secret isn't just picking what to buy, it's knowing when to buy. And that when, well, it's often hiding in plain sight, right there in the charts. Every superhero has an origin story, right? Well, it turns out these super stocks are no different. When you look at the charts, their epic journeys almost always begin in one of two very distinct ways. And wow, are they different? On the one hand, you have the flat base. This is like a rocket just sitting on the launch pad, quietly fueling up. The stock goes sideways, sometimes for months, even years. This is usually where the big institutions are slowly, quietly buying up shares. And then you have its wild cousin, the V-shaped start. This is pure whiplash, a huge, scary drop, and then bam, a violent, vertical rebound out of nowhere. So which one happens more often? Well, it's basically a coin toss. The super dramatic V-shape happens just a little bit more, but man, it is so hard to catch because it moves incredibly fast. The flat base, though, that's your friend. It gives you time to see what's happening and get ready for liftoff. Okay, the rocket has launched, but the journey to becoming a 10-bagger isn't just some chaotic, random scramble. The data shows the climb almost always follows one of four main flight paths. First up is the one everybody dreams about, the line shape. I mean, just look at it. It's this beautiful, steady, almost stress-free climb. This is the path you hope for, and it's actually the most common. And get this, it's also the fastest, averaging just about 2.3 years to hit that 10x return. Next, we've got the stair step, and it's pretty much exactly what it sounds like. The stock makes a big run up, and then it just pauses. It moves sideways for a bit, kind of like it's catching its breath, before starting the next climb. Now, those pauses can really test your nerves, but it's a totally normal part of the process. Then there's the rounded turn. You got to think of this one as the marathon, not a sprint. The climb is really gradual, slow, and it just follows this long, curving path. You need a ton of patience for this one because it's tied for the longest trip to the top, an average of 3.5 years. And finally, the most dramatic and the rarest path of all, the two-hump shape. This thing is a real roller coaster. The stock has an amazing run-up, that's the first hump, but then it hits a wall, a massive, painful drop that can wipe out almost all of your gains. This is where most people get scared and sell. But for the few who can hold on, a second, much bigger climb comes next, making that first one look tiny. Okay, so we have these four big picture shapes, but what's the engine driving them? What's the fundamental repeating pattern, the heartbeat, really, that builds these huge climbs? Well, the answer is a pattern called the measured move up. The easiest way to think about it is 2 steps forward, 1 step back. This repeating rhythm of climb, pull back, climb again, that's the basic building block for all those bigger shapes we just saw. It's like the DNA of a huge uptrend. And it breaks down into 3 really simple parts. First, you get a strong straight line run up. Then comes that corrective phase, the 1 step back, where the price drops or just moves sideways. And finally, you get a second leg up. And the really cool part is that second leg is often about the same size as the first. This little dance just repeats over and over again. Now let's be honest, that corrective phase can be absolutely gut-wrenching. The data shows that the median pullback is a staggering 35%. I mean, can you imagine watching your investment drop by over a third? It feels like a total disaster. But for these monster stocks, it's often just a normal pause before the next major surge. As they say, what goes up must come down. And when we're talking about 10-baggers, the end is just as important and just as predictable as the beginning and the climb. Because knowing how these things end is the key to actually keeping your money. And the end usually comes in one of two ways. The more common one is the rounded turn. The price peaks and then just kind of lingers up there for months before it slowly starts to roll over and drift down. But the other one, that's the inverted V. A super sharp, spiky peak followed by a fall that is just terrifyingly fast and steep. If you blink, you miss your chance to get out.
66%. Let that number just sit there for a second. What in the world do you think that represents?
That is the average amount a one-bagger stock falls in the single year after it hits its peak. You can spend years riding a stock up only to see 2/3 of your gains completely evaporate if you don't recognize that the party's over. This is why the exit is everything. So we've gone on a whole journey here through the birth, the climb, and the inevitable fall of a stock market giant. Let's put it all together in a quick and simple field guide you can use to spot these things in the wild. This table right here is the entire playbook. You can see how at every single stage, the birth, the climb, and the end, there are only a couple of dominant patterns. You start to see that the chaos of the market actually has a surprisingly predictable structure if you know what to look for. Each stage has its own signature. And that really brings us to the final and most important question. Looking back on a chart, these patterns seem so obvious, right? They just jump off the page. But the real challenge, the real secret to all of this, is training your eyes to see them as they're happening right now. Because the next giant is out there, and it's just beginning its journey. You know that thrill you get when you buy a stock? It's fantastic. But what about the anxiety of selling? You buy, the stock goes up, and now what? If you sell too early, you kick yourself for the money you left on the table. But if you sell too late, you watch all those profits just vanish. It's that classic investor's nightmare, right? So that's what we're going to do in this explainer. We're going to build a toolkit to help you answer that one crucial question with a lot more confidence. So, you've heard the mantra, right? Buy and hold. Sounds so simple. But here's the thing, and it's a huge flaw. Nobody ever tells you when to sell. Are you supposed to hold on forever, no matter what happens? Or does it just mean buy and hope for the best? This is the fundamental problem we're going to tackle head-on. Okay, so to figure out when to sell, you've got to know where you are in the first place. A good way to think about it is that a stock's entire life is a journey, one that has 4 really distinct stages. Understanding this map is the absolute first step to making smarter and way more timely decisions. And this map, it's actually based on a classic model from investing legend Stan Weinstein. See, he figured out a really simple way to see the big picture. By just using a 30-week moving average, you can divide a stock's life into 4 pretty predictable phases. It's almost like having an X-ray of the market, showing you what's really going on under all the noise. All right, so take a look at this chart. This shows you the whole shebang, the entire life cycle. First up, you've got stage 1. That's the basing area. The stock is just kind of bobbing around like a cork on water. Not much is happening. Then comes stage 2, the advancing phase, and this is the launch sequence. This is the rocket ship taking off, and this is where you make your money. Stage 3 is the top. That's where the rocket starts to run out of fuel and lose momentum. And stage 4, well, that's the decline. And you really need to be out of your seat before the whole thing comes crashing back to earth. Okay, so that's the map. But does it actually lead to any treasure? Well, the data is pretty darn clear. Oh yeah, it does. Just look at this table. It shows the results from real trades based on these stages, and wow, the difference is staggering. Buying in that quiet stage 1 basing area and then selling during that powerful stage 2 advance gives you an average gain of almost 26%. I mean, come on, that is a massive edge to have.
Okay, so the 4-stage map gives us the bird's eye view, right? But how do you spot the exact moment a trend is about to turn? Well, let's zoom in from the map and start looking at the actual road signs that tell you a big turn is just up ahead.
Now, this next method is just beautiful in its simplicity, but it's also incredibly powerful. It comes from a trader named Victor Sperndale. So to spot the end of a downtrend, you're just looking for 3 simple things to happen. First, the price has to break through its downward trend line. Second, it tries to fall again, but it can't quite make a new low. And third, it rallies and pushes past its most recent little peak. And boom, 1, 2, 3, the trend has officially turned around. And you know what's so cool about this? The beauty of this method is that it works both ways. So if you look on the left, you see that 1, 2, 3 pattern signaling the bottom. That's your cue to buy. And then on the right, you see the exact same logic, but in reverse. It's marking the top of an uptrend. That's a huge warning sign that it might be time to get out.
It's a really powerful and versatile tool no matter what the market is doing. Okay, but let's be real. Does this thing actually work? Well, the proof is in the pudding, as they say. When you use this 1-2-3 method to spot the end of a downtrend, how often does it actually lead to a big rise? We're talking 20% or more. A whopping 73% of the time. Think about that. That's a massive, massive edge in your favor.
So, spotting a trend change is awesome. But what about setting a specific price to sell at? Let's get to our next tool, which is just a fantastic way to nail down a concrete target for a stock that's trying to recover from a huge fall.
It's called the Cloudbank pattern, and it's a pretty fascinating way to find a sell target. What you do is look for a stock that was trading sideways for a long time. That's the cloud. You can kind of think of this cloud area as the stock's happy place, right? It's normal, fair value. And then disaster strikes. A market crash, some bad news, whatever, and the price just tanks. But here's the thing. That old cloud, it now acts like a powerful magnet, a natural target for the price to come back to. Check this out. This is a perfect example. For years, this stock was just cruising along, totally happy in that Cloudbank area above 56 bucks. Then wham, the bottom completely fell out. But here's the key. For an investor who was brave enough to buy down near the low, that Cloudbank isn't just some distant memory. It's a destination. It becomes this clear visual target. The idea is that the stock just wants to go home, back to its normal price. So after a stock takes a nosedive like that, what does the recovery actually look like? Well, as you can see, they come in a few different flavors, but the most common one, and it's not even close, is that sharp V-shaped bottom. It happens almost 2/3 of the time, and that tells you something important. The recovery is often just as fast and just as furious as the drop was. Okay, but here's the million-dollar question. Does the stock actually make it back to the cloud? This next number is the key statistic for this whole strategy, and honestly, it's a stunner. Are you ready? An incredible 82% of stocks that have this Cloudbank pattern and start to recover, they make it all the way back to the bottom of that cloud. And get this? They usually do it within just a year and a half. So what's the big takeaway here? What's the rule? It boils down to a really simple, actionable rule. Once your stock has made that incredible journey all the way back to the bottom of that old cloud, it's probably time to take your profits and head for the exit. Why? Because the data is pretty clear that trying to push through that cloud is a long, slow, grinding fight, and the easy money has already been made. All right, we've covered the big picture map. We've talked about specific price targets. Now let's fill out the rest of your toolkit with some quick, practical, real-world rules you can start using right away. First up, trailing stops. Think of this as your automatic profit protection system. A really good place to start is setting it just below that 30-week moving average we talked about. As the stock climbs, you just keep raising your stop loss, locking in more and more of your gains. And hey, if the stock goes absolutely vertical, a straight shot to the moon, you've got to tighten that stop up to make sure you don't give back all those awesome profits when it turns. Now, this next piece of advice is golden, so listen up. A stop loss is a machine, right? It's just a mechanical tool. But your intuition, that's a powerful weapon. So if you get that nagging feeling, in your gut that the stock is about to turn and hit your stop, don't wait. Just sell. Trusting that instinct can often save you from that last painful drop. Okay, need a super quick way to check if your stock might be getting a little too pricey? Here are 2 simple red flags. First, check the company's market cap, its total price tag. If that's bigger than its annual sales, that's a warning sign. And second, look at its PE ratio. If it's higher than it's been at any point in the last 3 years, that's another signal that things might be getting a bit frothy. All right, here is a brilliantly simple rule of thumb, especially for those big, stable blue chip stocks. It's this: if it drops 10% from its most recent high, you sell. Period. No questions, no hemming and hawing. It's a disciplined, emotion-free way to protect your money. So, why that number? Why 10%? Well, this chart kind of explains the logic behind it. See, in a healthy uptrend, stocks don't go up in a straight line. They move in waves. And as you can see, the most common little dips are in that 5 to 7% range. A drop of 10%, well, that's an outlier. That's a sign that something might be fundamentally wrong, that the tide could be turning against you for real. So, what's the bottom line here? In the end, there's no one single magic sell signal that works every single time. The real secret to selling well is just being prepared. It's about having a map so you know where you are. It's about seeing the signs to spot the turns, having targets to aim for, and of course having a full toolkit of rules to guide you. We've just handed you the tools. The only question left is, how are you going to use them to build your own winning strategy? Have you ever opened up a company's annual report and just felt your eyes glaze over? You're not alone. Today, we're going to cut right through all that noise. We are distilling the practical, battle-tested wisdom of investing expert Thomas Bulkowski into a simple, powerful checklist. The whole point is to help you vet a stock without getting totally lost in a sea of numbers. You know, Bulkowski tells this great story about an accountant he met who was trying to analyze Hewlett-Packard. The guy was literally shredding the annual report, trying to crunch every single number. Weeks later, Bulkowski saw him again, and he was still at it. And that right there is the perfect picture of analysis paralysis. See, the goal isn't to be a forensic accountant. It's about finding clear, compelling evidence, and that's exactly what we're going to focus on today.
So here's our game plan. It's a clear 5-part roadmap. First, we're going to talk about the right mindset for looking at these reports. Then I'll walk you through the checklist itself. From there, we'll dive into the really critical stuff, the red flags to avoid, the green lights that signal growth, and then we'll tackle that final crucial question. Is the price actually right?
The big idea here, the whole philosophy, is that fundamental analysis isn't about some secret formula or one magic number that screams buy or sell. Nope, it's much more like being a detective. You're building a case, a body of evidence, for or against a company's financial health. And this is a really key mindset to have. You got to think of these rules we're about to cover not as rigid laws, but as snapshots in time. Bulkowski himself even admits he can overemphasize them sometimes, but his philosophy is pretty simple. Better safe than sorry. Every point we cover is just one more piece of evidence you're adding to your case file on a particular stock. All right, let's get to the good stuff, the practical part. I want you to think of this checklist as your personal toolkit. It's a set of simple but really powerful rules for playing both defense and offense when you're making your investment decisions. We're going to split this toolkit into 2 main sections. First, we're going to play defense. We'll cover the warning signs, the financial red flags that tell you to slow down or be cautious. Then, after that, we'll switch gears and go on offense, looking for all the positive signals, the signs of a really healthy, growing company. So let's start with defense. First things first, we're digging into the warning signs. These are the things that should make you pause, proceed with caution, or maybe just walk away entirely. Think of these as the crucial first checks you make to protect your capital. First up is something called burn rate. This is super relevant, especially for newer startup-type companies. So what is it? It's basically how fast a company is burning through its cash. If that rate is too high, it means they're going to need more money, and soon. And how did they usually get it? By selling more stock. That dilutes the value of your shares, and you'll often see the price take a nosedive. Bulkowski points to Mankind stock, which fell 23% after the company had to do just that. Next on the list, debt. Let's talk about it. Bulkowski is a big fan of cash. He loves companies that aren't drowning in debt. I mean, no debt is obviously the best case scenario, but a debt-to-equity ratio below 50% is usually seen as manageable. The real red flag pops up when a company's debt starts creeping over 70% of its total capital. That's when things can get pretty risky. Okay, 2 more big red flags to keep an eye out for. First, litigation. If you're scanning an annual report and you see lawsuit after lawsuit, that's often a pretty glaring sign of poor management. Second is the current ratio. It sounds technical, but it's a super simple and powerful formula. You just take the company's current assets and divide them by its current liabilities. What does that tell you? Basically, can it pay its short-term bills? You're looking for a healthy number here, ideally something greater than 2.0. All right, enough of the scary stuff. We've covered what to avoid. Now let's pivot to the fun part, the proactive signals of a healthy, growing company that might actually be worth your investment. These are the green lights we're looking for. The first green light is the price to book value. Now, some traders might say book value is a bit of an old school metric, but Bulkowski really likes it because it gives you a tangible baseline for what the company's worth. He looks for 2 things. 1, that the company's book value is actually rising over time, and 2, that the price to book ratio is under 2.0. And with this one, the lower the better. Here are 3 more really powerful signs of a healthy company.
First, look for consistently rising earnings. You don't want a one-hit wonder. Ideally, you see 5 years of steady growth. Second, check for dividends. They're great because they not only give you some income, but they also tend to act as a cushion, supporting a stock's price during a market downturn. And third, see if the company is boosting its R&D funding. That is a crystal clear sign that it's serious about investing in its own future. Okay, pop quiz for you. You see in the news that a company is pouring a ton of money into building a huge new factory or some other massive project. Is that a clear signal to go out and buy the stock? You'd think so, right? It sounds intuitive, but Bulkowski's answer is a firm not yet. He argues that when a company's capital spending is super high, that's actually not the time to buy. The real opportunity, the sweet spot, comes after all that spending winds down and the company is just about to start profiting from that big investment. So the crucial point is this 3-step pattern. It's a sequence. First, the company spends a lot of money. Then, and this is the key, you look for its capital spending to actually decrease for 2 years in a row. That's your signal. It tells you the company is shifting from spending money to making money from that big project. Okay, so we've checked out the company's health. It doesn't have any major red flags, and it's got plenty of green lights. So are we ready to buy? Not quite. Before pulling the trigger, Bulkowski makes a few final checks on the stock's price and how it's actually behaving in the market. A classic final check is the price-to-earnings ratio. But there's a twist. You can't just look at the number in a vacuum. You have to compare it to the average PE for that specific industry. Sure, a lower PE might signal good value, but you have to do your homework. You need to find out why it's low. Remember, management will always be optimistic. Let the price be your unbiased guide. Now, this next one is more of a personal preference from Bulkowski, but it's one that's backed by his own observations and data. He generally avoids penny stocks that are under $1, and he finds that his personal sweet spot, where he sees the best performance, is in stocks priced somewhere between $5 and $20. And here are 3 final quick-fire checks to round out your analysis. First, take a peek at the price-to-sales ratio. A value under 1.0 could suggest the stock is cheap compared to the revenue it's bringing in. Second, he recommends focusing on small-cap stocks. Why? Because historically, they've tended to outperform their larger counterparts over the long haul. And finally, this is a crucial one. Make sure your planned trade is less than 1% of the stock's average daily volume. This is all about liquidity, making sure you can get in and out of the stock easily without getting stuck. So let's just boil this all down. This isn't an exhaustive end-all be-all list, but it's a really powerful framework. Essentially, you're looking for a small-cap company that has a rising book value, low debt, a healthy current ratio, consistently growing earnings, and that key timing signal, it's just finished a major spending cycle. So there you have it. We've just walked through a simplified but really potent checklist from a seasoned trader. It's all designed to help you build evidence and gain confidence in your decisions. So the only question left is, what's the first company you're going to put to the test? All right, let's jump right in. Have you ever been sitting on a winning stock, watching those profits climb and climb, only to then watch them just disappear over time? If that sounds painfully familiar, then you're going to want to stick around because we're about to explore a strategy called position trading, and it might just be the different approach you've been looking for. You know, this quote comes straight from our source author, and man, does it capture that just gut-wrenching feeling. You see a huge win on paper, and then it turns into a break-even trade, or worse, a loss. It's a kind of thing that makes you sit back and think, there has to be a better way to do this. Yeah, I'm willing to bet that for a lot of you out there, this is hitting a nerve. It's an incredibly common story, and it's the exact problem we're going to dig into today. So what's really at the heart of this frustration? Well, for a lot of people, it starts with a very popular but sometimes tricky strategy. And that brings us to what I like to call the buy and hold blues. You know, that special kind of agony that can come from sticking with a stock through absolutely everything, sometimes for way, way too long. There's a classic example that really drives this home. So let's take a look at Intel back in the late 90s. If you bought in 95, you were feeling like an absolute genius as it shot up to almost $76 by the year 2000. But if you held on after that tech bubble burst, you experienced this slow, painful bleed out of all those gains. The source calls it a water torture agony, which is pretty spot on. I mean, think about it. A full decade later, it hadn't even recovered half its value. The trend had clearly, fundamentally changed. So there has to be a different way to think about this, right? And that's where our main topic for today comes in, position trading. It's a trend-following strategy that is specifically designed to help you avoid that kind of long, drawn-out profit erosion by giving you a framework for knowing when to get out. To put it really simply, position trading is all about riding the wave. But, and this is the important part, you get off before it crashes into the shore. You hold a stock for weeks, maybe even months, but only as long as its main upward trend is going strong. The second that primary trend starts to turn, you're out. The key here isn't time, it's the trend. You're only on board as long as that trend is your friend. And the difference in philosophy here is just massive. With buy and hold, you're basically buckling in for the whole roller coaster, right? You're committed to riding out every single stomach-churning drop, just hoping it eventually goes back up. With position trading, your goal is totally different. You're trying to be the driver, not the passenger. You're actively trying to time the market to capture one specific major move, and then get out, protecting your cash and, of course, your profits. So you might be wondering, okay, this sounds interesting, but is it actually for me? And that's a great question because it's not for everyone. But for certain kinds of investors, it can be a fantastic middle ground between staring at charts all day and just buying something and forgetting about it for 10 years. So who's this really for? Well, if you're that buy and hold investor we just talked about, the one who's just sick and tired of watching another Intel scenario play out in your portfolio, this could be for you. Or, hey, maybe you're on the other end of the spectrum, a day trader who's just burned out from the constant stress and the commission costs. This more relaxed style could be a huge relief. But really, at its core, it's for anyone who wants to put more focus on timing their exit as a way to protect against those really devastating losses. All right, enough theory. Theory is great, but let's get our hands dirty and see how this actually plays out in the real world. We're going to walk through a real position trade from our source material and see exactly what the buy, hold, and sell signals looked like. Okay, check this out. This is a chart for a trade in Ann Taylor's stock. And get this wasn't some quick in and out flip. This was a 9-month hold that pulled in a pretty incredible 78% gain. So how'd they do it? Let's break it down. Okay, let's deconstruct this step by step. First up, the buy signal. The trader spotted a really powerful bullish chart pattern called a high and tight flag, which can often come before a big move up. But they didn't just jump in. They waited for a catalyst, a positive earnings report, to confirm the signal and pull the trigger. Next, the hold. This is the simple but not always easy part. For 9 months, they just let the trend do the work, ignoring the minor dips along the way. And finally, the sell signal. Now this is key. It wasn't just one thing. It was a whole bunch of clues pointing to the exit. The chart was looking tired, a well-known seasonal trend, sell in May and go away, was right around the corner, and the outlook for the broader market was getting a little shaky. The evidence was piling up, time to sell and lock in that profit. So the entry was triggered at $12.36 a share, right as that good news on earnings came out. And 9 months later, with all those sell signals flashing, the position was closed out at $22.06. And here's what's really important to get from that trade. Notice they didn't try to buy the absolute bottom, and they didn't sell at the absolute tippy top. That's not the goal. The goal was to capture the majority of that big primary move, that 78% sweet spot in the middle, and then get out, protecting that gain before a reversal could take it all back. So let's bring it all together. You know, like any strategy, position trading is not a magic bullet. It has some really clear advantages for sure, but it also comes with its own set of challenges that you have to be aware of. Let's look at the pros and cons. On the plus side, the whole strategy is built to avoid those massive, painful losses that wipe out your profits. It's also way less stressful than day trading, and it can help you stay safe on the sidelines during a big market crash. But on the other hand, it's not perfect. It's not going to fix bad discipline, and you're probably not going to land a 10-bagger because the strategy tells you to sell before a stock goes completely parabolic. And let's be honest, it still requires market timing, which is one of the hardest games there is. So if there's one thing you take away from all this, let it be this. Position trading isn't trying to sell you some risk-free fantasy. It's a really pragmatic approach. The entire philosophy is built around actively managing your risk with one primary goal in mind, keeping the profits you've worked so hard to make. And that kind of leaves us with one final question to chew on. Take a hard look at your own approach to the market. When you're in a winning position, does your current strategy have a clear, defined plan to protect those profits? Or are you just kind of hoping for the best? All right, let's talk position trading. You know, holding stocks for the long haul. Months, even years. But here's a wild thought for you.
what if I told you that some of the absolute biggest home runs come from stocks that have been completely demolished, stocks that have lost half their value or even more? It all kicks off with this one surprising number. Yup, 68%. So what is this? What does it mean? Well, that's the success rate, believe it or not, for a very specific type of stock, the ones that have been absolutely hammered, just beaten down by the market. So let's break that down. The source material for today's explainer points out that stocks dropping 50% or more actually outperform the market the following year 68% of the time. Now, on the surface, that sounds like a secret formula, right? Just go find the biggest losers, scoop them up, and wait. But if only it were that simple. I mean, come on, if it was that easy, we'd all be rich, right? The hard truth is that for every amazing comeback story you hear about, there's another stock that just keeps falling, all the way to zero. So the real trick, the million-dollar question, is how do you tell the difference? And that's what brings us to our first big idea, the tip and the trap. Because jumping on one of these beaten-down stocks, well, it can either be the smartest trade you'll ever make or a trap that will absolutely wreck your portfolio. Okay, check this out. On the left, you've got a winner's story, a stock like Ann Taylor. It got crushed, dropping a crazy 91% during the '08 bear market, but then it staged this epic recovery, a huge win if you were patient. But then, look at the right. This is the trap, a company called Mipio. It had a similar brutal drop, but its story, yeah, it ended in bankruptcy. You see the problem? It's the same setup, but two totally opposite outcomes. So let's dig into this Mipio story because it's a perfect cautionary tale. The author of our source material actually bought this stock. He saw what looked like potential, they had some promising drugs in development, but, his gut told him something was off, and he got out with a tiny 8% gain, just deciding the risk was too much. And get this, a month after he sold, a broker put out a buy recommendation on it. But by December of the next year, the company was filing for bankruptcy. It just goes to show you, a stock can look shiny on the outside and be completely rotten on the inside. And that's the big takeaway here, isn't it? Not all value plays are actually good value. Just because a stock is cheap or has fallen off a cliff, that doesn't automatically make it a good buy. The whole game is learning to spot the difference between a company that's just sick and one that's on its deathbed. Okay, so how in the world do we do that? How do we spot the difference? Well, it all starts with understanding how the market moves. And for that, we're going to use a really cool analogy: ripples, waves, and tides. I want you to picture the market as a giant ocean. You've got these tiny little up and down price changes every second, right? Those are the ripples. That's where day traders live. Then you've got the bigger movements over days or weeks. Those are the waves. That's swing trading territory. But for us, for position traders, we're interested in the tides, the huge, powerful, long-term trend of the whole market. And really, that's what a position trader is. It's someone who learns to ignore all that daily noise, the ripples and the waves, and just focuses on one simple, powerful question. Which way is the tide moving? Is the tide of the market coming in, like in a bull market, or is it heading out, like in a bear market? You've definitely heard this saying before: a rising tide lifts all boats. In position trading, that's not just a saying. It's the golden rule. You always want to be trading with the tide, with that primary trend. Trying to swim against it is just exhausting, and it's usually a great way to lose money. The whole idea is to let that massive market momentum do all the hard work for you. All right, so trade with the tide. Got it. But how do you know when the tide is actually turning? That's the key, right? Well, one of the absolute best clues is watching how a stock reacts to news. Let me give you a fantastic example. Toys R Us back in late 2003. The company was in deep trouble. The stock had been cut in half and sentiment was just awful. Everyone hated it. Then they released some truly dismal earnings reports. So you'd expect the stock to get crushed again, right? But what happened? It dropped 2 cents. That's it. Why? Because all the bad news, all the negativity was already baked into the price. That non-reaction was a massive signal that the selling was exhausted. And sure enough, the stock shot up 20% over the next month. So this gives us a really simple but powerful rule. When a stock gets hit with terrible news but doesn't really go down, that's a huge sign of strength. It's telling you a bottom is probably in. All the sellers are gone. And the reverse is true too. When a stock gets amazing, incredible news and kind of just sits there, doesn't go up much, that's a major red flag. It's a sign of weakness, and it could mean a top is forming.
And this all leads us to maybe the single most important concept we're going to talk about today. The huge difference between trying to fish for a bottom and waiting to buy something that's already started to rise.
So I want to ask you a question. Just look at this chart for a second. Imagine you have two chances to buy this stock at the exact same price. Point A or point B. Which one do you pick? Think about it for a second.
All right, let's really break this down because honestly, this one image is probably the most important that you'll see in this whole explainer. At point A, the stock is in a free fall. At point B, it has already hit bottom and is now on its way back up. They're at the exact same price, but they represent two completely different worlds of trading.
Buying at point A, that's what we call bottom fishing, or as I like to call it, trying to catch a falling knife. It's dangerous. You're fighting the primary trend, basically just guessing and praying you've found the bottom. But point B, that's momentum trading. You're waiting for proof that the trend has actually turned. Now, yeah, you're not going to buy at the absolute perfect low. You miss that. But who cares? You're buying with the new tide, the new momentum pushing you forward.
Okay, so let's tie all of this together. Let's see how these ideas, the tides, the news reaction, buying with momentum, all play out in a real trade. We're going to walk through a case study from the source material, a trade in Hawaiian Electric.
So here's how it went down. First, you have the disaster. We're in the pit of the 2009 bear market, and this stock just collapses, down 43% in 3 weeks. That's the chaos that creates the opportunity. Step 2 is the research. Instead of running for the hills, the author actually does his homework, checks the financials, and realizes the company is actually solid. Then, the most crucial part, the entry. He doesn't try to catch that falling knife. No way. He waits for the decline to stop, for that V-shaped bounce to begin, and then he buys after the momentum has clearly shifted. And finally, the exit, months later with a nice profit. And you can see the whole thing right here on this chart. Look at that terrifying straight down drop. That is absolutely not where you want to buy. The time to buy is over here, after the chaos, after it has bounced, when the recovery is underway. See, he's not trying to be a hero and buy at the very bottom. He's buying at our point B, when the momentum, the tide has turned in his favor.
So, what are the big lessons we can pull from this? 1. Look for opportunity when everyone else is panicking. 2. Always do your own research to make sure you're buying a solid company, not just a cheap stock. And 3, this is the big one. Don't try to catch a falling knife. Wait for the momentum to turn. Your job isn't to find the bottom, it's to catch the new tide as it starts rolling in.
And really, that's what this all boils down to. The goal isn't to be a hero who buys at the absolute perfect bottom tick. That's a fool's game. The goal is to be a smart trader who waits patiently until the odds have finally, clearly shifted in your favor. It's about waiting for the evidence, seeing the tide has turned, and then, and only then, feeling confident enough to get in the water. You ever look at a stock chart and just wonder, how does anyone make sense of all those squiggly lines? It can really feel like you're trying to guess the future. But what if there was a system, a simple checklist even, that could help you tell the difference between a dud and a potential breakout star? Well, today, we're going to pull back the curtain on how pros analyze charts using a really powerful 10-point system. Let's see if we can crack the code together.
So check this out. This is a chart for a company called Stillwater Mining. You can see it formed this kind of W shape down at the bottom, right? And after that, the stock just absolutely exploded. It gained a massive 472%. So the big question is, was that just a random lucky break? Or could a trader using a clear system have actually seen this coming? This is the mystery we're going to dive into. We're going to play detective and see if a straightforward checklist could have flagged this stock as a potential winner way before that massive price jump. Now, to solve this, we've got to focus on one really specific clue on that chart. It's a pattern that traders call the double bottom. And what's super interesting is that it's not just the pattern itself that matters, but all the subtle little differences within it. So what is a double bottom? Well, just like the name says, it's where a stock's price drops, bounces back a bit, and then drops again to form two distinct lows or valleys right around the same price level. For traders, this is a classic heads up that a downward slide might be running out of gas and getting ready to turn around.
But here's where things get really interesting. Not all of these double bottoms are created equal. They actually come in 4 main flavors, and they have these cool names, Adam and Eve, based on the shape of those two valleys. So you can get an Adam and an Eve. You get the idea. So okay, what's the difference?
Well, atom bottoms are really sharp and spiky, like a V. Think of a quick, sudden price drop and a fast recovery. Eve bottoms, on the other hand, are way more rounded and gentle, kind of like a U shape that forms over a longer period. And this isn't just for looks. As we're about to see, the shape actually makes a huge difference in how the stock performs. And that brings us right to the heart of this whole thing, the checklist. We are going to apply a 10-point scoring system to our mystery stock, Stillwater Mining, and see if it passes the test. Each factor will get either a +1, a -1, or a 0. All right, let the investigation begin. All right, first up, the downtrend before the pattern started lasted for more than 3 months, which the system considers neutral, so that's a 0. Second, the pattern didn't have a flat base, which is just a period where the price kind of goes sideways for a while. The system sees not having one as a small negative, so that's a -1. And finally, there was some overhead resistance, which is basically a price ceiling where the stock had stalled out before. That's another -1. So, after just 3 factors, we're already at -2. Not exactly a great start, right? You might be thinking, okay, I'd pass on this trade. But hold on, we are far from done.
Okay, now things start to turn around. The pattern formed near the stock's yearly low, and that's a really positive sign of a potential comeback. +1. It was also a tall pattern, meaning there was a big drop from the peak to the bottom. That suggests the reversal could be way more powerful. Another +1. And this is critical. Trading volume was drying up as the pattern was forming, a great sign that sellers were just getting tired. And then, boom, on the day the price broke out to the upside, volume surged. That's a huge stamp of approval from buyers. So we add 2 more points for that. That's 4 positives in a row.
And just like that, we flipped from -2 all the way to a +2. Okay, let's look at the final few factors and get our final verdict.
All right, for our last 3 points, the stock did have something called a throwback. That's just a little dip back down to retest the breakout level. It shows a tiny bit of hesitation, so that's a -1. However, on that same breakout day, the price gapped up, meaning it opened way higher than it closed the day before. That's a super powerful sign of excitement from buyers, so we add a point back. And finally, Stillwater was a smaller company, what you'd call a small cap stock, and those historically just have more room to run. That's our final +1.
So, when all is said and done, what do we have? A final score of +3. And what happened next? A 472% gain. The checklist worked. It successfully flagged this stock as having the key ingredients of a big winner. Mystery solved.
But you have to wonder, right? Was Stillwater Mining just a one-off, a lucky guess? Or does this scoring system actually hold up when you look at a whole bunch of data? Well, the researcher behind all this, Thomas Bulkowski, did exactly that. He crunched the numbers on over 1,000 examples.
And the results are pretty clear. In a bull market, patterns that scored anything above 0 posted an average gain of 53%. And the ones with a negative score, they only gained about 38%. I mean, that is a huge performance difference, all identified by this simple checklist.
And as the author himself puts it, it's not just about being positive versus negative. There's a clear trend here. The higher the score, the stronger the performance tends to be. So a stock that scores a +5 is, on average, likely to do even better than one that scores a +1.
Of course, a really good system isn't just about finding the winners. It's just as important that it helps you steer clear of the losers. So let's take a quick look at a counterexample, just to see how powerful this checklist is on the other side of the coin. Okay, this is a chart for lumber liquidators. And at first glance, it looks pretty similar to Stillwater Mining, doesn't it? It's got that same double bottom W shape. But what happens when we actually run this one through the checklist?
Well, it fails on some really important points. Unlike our winner, the volume was actually going up as the pattern formed, which suggests sellers were still very much in control. The breakout volume was weak, no real conviction there. It also had that hesitant throwback, and there was no explosive gap up on breakout day. According to the system, these are all red flags, and they add up to a pretty dismal final score of -3.
And the result? A measly 5% gain before it just fizzled out. You see, the pattern looked okay on the surface, but the engine underneath was sputtering. The checklist was right. It correctly warned that this stock was probably going to be a dud.
So what's the big takeaway here? The author describes this system as a kind of GPS for traders.
It's not about blindly following a machine. It's about having a reliable guide to help you navigate the markets, spot real opportunities, and, just as importantly, avoid the potential hazards. And this really gets to the core philosophy of this whole approach. It's so tempting to think that you need a dozen screens with a million complex indicators to be successful. But what this system really proves is that sometimes less is so much more. The key is often to simplify your rules down to what actually works, because that's the most direct path to stacking the odds in your favor. You know, this whole idea of using a simple, effective checklist is just incredibly powerful. It clearly works for trading, but it really makes you wonder, what other big, complicated, maybe even emotional decisions in our own lives could be made a whole lot clearer and more successful just by applying a simple, well-thought-out checklist? Definitely something to think about. 3 winning trades and a funeral. Sounds pretty dramatic, right? Well, that's exactly what we're diving into today. We're going to look at the raw reality of stock trading, the good, the bad, and the ugly, through 4 really powerful case studies. And they'll show us just how important strategy, emotion, and, that little inner voice really are. Okay, let's just start with this quote because it really sets the stage perfectly. After 30 years in the markets, I still have not figured out which trades will work and which ones will not. I mean, wow. This comes from someone who's been in the trenches for decades. And it tells you right away this isn't about finding some magic formula. It's all about dealing with uncertainty. It's a huge reminder that probably the most valuable thing a trader can have is a little bit of humility. All right, so first up, let's talk about the big conflict at the heart of every single trade. What you think it's going to be like versus what it's actually like. You see this all the time, right? On the one hand, you've got the ideal trade, the one you see in textbooks. It's a perfect reversal, the price just launches like a rocket ship, everything is clean and predictable. But then there's the real trade. That's what it actually feels like to have your money on the line. It starts out calm, but then the stormy clouds roll in, the worrying starts, and that little voice in your head just won't shut up asking, is this going to work? And this quote just hits the nail on the head. I can teach you when to buy, but a millisecond after you put your money down, things get hairy. That's it, isn't it? The signals, the patterns, you can learn all that stuff. But the second your cash is at risk, the whole game changes. Suddenly, it's not about charts anymore. It's about managing your own fear, your own greed, and all that uncertainty. That's where the real learning happens. So, let's see this in the real world. Our first case study, we're calling it the funeral. A bit dramatic, I know, but it's because every trader has losses. That's a given. But the really smart ones, they don't just bury them. They treat them like their absolute most valuable lessons. Okay, so here's the scene. It's January 16th, 2008. The company is Intel. And they just announced earnings that were, well, not great. Worse than expected. So the plan seemed super simple. Short the stock. Bet that it's going to go down. I mean, on paper, this looks like a slam dunk, right? But then, look at this timeline. It's pure chaos. The night before, that inner voice actually told the trader to cut the position in half, which, spoiler alert, saved them from an even bigger disaster. Then the market opens. The stock tanks, just like they thought. But it stops. It doesn't keep going. And then, seconds later, wham, the price shoots up, forcing them to get out for a small loss. And here is where it all goes wrong. This is the big mistake. Driven by pure emotion, they immediately flip their position and buy the stock right near the high of the day. And what happens? A few minutes later, they're selling again for another loss right as the stock finally makes the big downward move they predicted in the first place. It's just a classic case of emotional whiplash. So, the actual loss in that 30-minute fiasco, it was $550. Okay, not the end of the world. But here's the crazy part. If you were to repeat that 30-minute performance for a whole year, what would that look like? The annualized loss would be a whopping $929,500. It just goes to show you how these small, rapid-fire mistakes can add up to something absolutely monumental. Okay, enough of the funeral. Let's move from all that chaos to a bit more control. Our first winning trade. And this one is a whole different story. It's all about a methodical, technical approach, but also really careful management. So here we're looking at Hudson Highland Group, ticker HHGP. Now, this was a pretty complex trade, and it all started with spotting a very specific, very classic chart pattern right at the bottom of a nasty downtrend. And that pattern,
It's the good old head and shoulders bottom. If you're not familiar, just picture an upside-down person. You get a trough for the left shoulder, then a deeper one for the head, and then another smaller one for the right shoulder. When you see this pattern complete, it's a really classic signal. It's basically the market telling you, hey, the sellers might be running out of steam here, and the buyers are starting to step in.
So the key thing here is that this wasn't just some random guess. It was a totally calculated entry, based on a checklist. The pattern was there, but the trader's own scoring system gave it a -1, so caution was needed. They knew there was overhead resistance at $8 and then again around 12 or 13. Good news was, earnings were already out of the way, so no surprise there. But the overall market was weak, which prompted them to cut the position size way down, just a quarter of what they'd normally do. And the entry itself timed perfectly on a 38% Fibonacci pullback of a recent up move. Very methodical.
But here's what's so cool. Even with all that technical analysis, this is where the feel for the market comes in. The trader says, I feel the stop is too close, and I want this trade to be a long-term holding. See that? It's intuition, it's experience. They wanted to give the trade room to breathe, overriding a purely mechanical rule with a sense of the trade's bigger potential.
And what was the result of mixing all that technical skill with that careful, intuitive management? A very nice 33% average gain in just 2 months. A really solid win, built on a solid foundation.
All right, next up, we're going to look at a totally different style of trade. This wasn't a long, slow, methodical climb. Nope, this one was all about seizing a fast, explosive, opportunistic moment.
Okay, so this is CNO Financial. And I mean, look at that chart. The first thing that just jumps right out at you is that massive price surge on the left. The stock literally doubled in less than 2 months. Now that is the kind of move that gets your attention, for sure.
But that kind of move also brings up a huge question, right? How in the world do you jump on a stock that's already a rocket ship without getting totally burned? I mean, chasing a move like this is one of the riskiest things you can do in trading.
And believe me, the risk was very, very real. Just listen to this. A stomach-churning drop of 16% below my buy price. That happened the day after they bought in. Can you imagine? That is a serious gut check. Any standard tight stop loss would have booted you right out of the trade for a loss, literally just before it turned around and rocketed higher.
But holding on through that pain really paid off. And knowing when to get out was just as critical as knowing when to get in. There wasn't just one signal, it was a whole bunch of things lining up. You had a technical pattern called an inverted dead cat bounce after the stock gapped up 29% on good news. You had another clue about a short-term reversal forming. And then you got the fundamental kicker. The company started making noises about issuing more stock, which would dilute the value. It was like the market was screaming, take your profits and get out.
And the reward for having the nerve to handle that volatility and for reading those exit signs so perfectly, an absolutely incredible 90% gain in just 2 months. Wow. Okay, on to our final winning trade. And this one is a story about the long haul. It's about patience. It's about holding your nerve through some truly massive swings. And it's also about being honest enough to admit that sometimes you just get plain lucky. This is Complete Production Services. And yeah, this chart looks like a roller coaster for a reason, because it was one. This wasn't a quick 2-month flip. This trade was held for nearly a full year. And boy, did it test this trader's conviction over and over again. So the whole reason for getting into this trade was based on a really powerful idea, a busted pattern. So a double top pattern is normally bearish, right? It's a sign that the price might be headed down. But what happens when that bearish pattern fails, when the price reverses and closes above the peaks? Well, that's what we call a busted double top. It traps all the people who were betting on it going down, and that can trigger an incredibly powerful move to the upside. But just because the setup is powerful doesn't mean the ride is easy. Just look at this. After getting in around $9, this trader had to sit through not one, but 2 separate, terrifying drops of over 30%. 30%. Can you imagine holding on through that twice? That takes an absolutely incredible amount of nerve. And this is where that humility we talked about at the beginning comes right back into play. Was this amazing win all skill? Not a chance. The trader is totally candid about it, saying, the potholes on the road to doubling my money were filled with luck, helped by a rising market, and surprisingly good earnings. That's just a refreshingly honest take on the reality of holding a trade for the long term.
Okay, so we've been through a funeral and three very, very different winning trades. So what's the big takeaway from all this? Well, it seems to be that it all comes down to blending that technical, book-smart knowledge with that hard-won in-the-trenches experience. So here's a kind of trader's checklist based on what we've seen. First, and maybe most importantly, you have to develop and then learn to obey your inner voice. Remember, it saved a ton of money in that Intel disaster. Use classic, time-tested patterns like the head and shoulders bottom to find good entry points. Be patient and buy on pullbacks, like that 38% retracement. Keep an eye out for those really powerful busted patterns. And finally, sell into strength. Have a clear signal to get out, like that inverted dead cat bounce we saw. You know, at the end of the day, the charts, they can give you a map. They can show you the patterns, the potential roads you can take, but that map is useless without a compass. And that compass, that's your experience. It's built from all your trades, the wins, and especially the funerals. So the real question to leave you with is this: how are you going to build your own?
All right, let's get real for a minute. Today, we're pulling back the curtain on something every single trader goes through, but not a lot of us like to admit: the trades that go completely horribly wrong. This isn't about bragging about the big wins. It's a totally honest look at the anatomy of failure.
You've heard this a million times, right? It's that classic piece of wisdom. You're supposed to learn from your mistakes, grow from them, become a better person, a better trader. It sounds great in theory. But come on, let's be honest, this is how we actually feel. As the author of our source material puts it, learning from success is just, well, it's a lot more profitable. Still, mistakes are inevitable. So today, we're going to do the next best thing: learn from someone else's mistakes. So, we've got 3 classic trading horror stories for you. We're going to look at the danger of holding on for way too long, the gut-wrenching regret of bailing out too early, and maybe the worst feeling of all, the absolute agony of selling right at the bottom. First up, motivation. This is a perfect textbook example of what happens when you let a beautiful winning trade turn into an absolute disaster. Just take a look at the story this chart tells. You see that gorgeous, steady climb starting around August 2009? Everything is going exactly to plan. And then it's like it just falls off a cliff. That vertical drop is what we're here to talk about. An event like this actually has a name, and it's a pretty brutal one: the dead cat bounce. It's a massive price collapse all in one day. And the key thing you have to remember is that after that first huge drop, the stock usually just keeps on falling. It's a total trap for anyone hoping to buy a bargain. So you might be asking, why on earth did this seem like such a sure thing? Well, Medivation was a biotech company, and they had this Alzheimer's drug called Dimebon that just looked unstoppable. I mean, it passed a phase 3 trial, got great results in another study, and they even locked in a partnership with Pfizer. The stock was, as the author said, priced for perfection. And this right here, this is the moment right before the world came crashing down. On March 2nd, 2010, the trader was sitting on a paper profit of almost 60%. It felt like a home run, a huge, undeniable win. And then, literally the very next day, the news dropped. The drug failed its final trial. The stock completely imploded. It gapped down 67% at the opening bell. That beautiful 59% gain didn't just disappear. It turned into a painful 48% loss. Just like that.
So, what's the big takeaway here? It's simple. When a stock takes a massive news-driven dive like this, you don't think, you don't hesitate, you sell. The author pulled the plug that same day, but even that was too late. The stock actually kept falling another 37% from there. The lesson is crystal clear. Get out and get out fast.
Okay, so we've seen the agony of selling too late. Now, let's flip the script and look at the opposite problem. That lingering, nagging regret you get from selling a winner way, way too soon. Here we're looking at a trade in Coldwater Creek. You can see the buy points, you see the nice climb up, and then you see the sale. But look at all that action that happens after the sale. That, my friends, is all the money that got left on the table. Now, the entry on this trade was actually pretty solid. The market was just starting to recover from the 2009 crash. The chart was showing what's called an ugly double bottom, a really strong reversal pattern. Plus, you had insiders buying shares, and the stock broke through a key resistance level. I mean, everything was screaming buy.
And hey, the trade worked. An 83% gain is fantastic. Nobody's going to complain about that. But here's the part that stings. If the trader had just held on a bit longer, that gain could have been closer to 200%. He almost tripled his money, but walked away with less than half of what he could have made.
So what was the culprit here? Ironically, it was a tight stop-loss order. He set it to protect his profits, thinking there might be a small pullback. But the stock barely even dipped. It just kissed his stop, took him out of the trade, and then kept rocketing higher without him. The very tool he used for protection cost him a massive win.
And that brings us to our final story, and maybe the most psychologically brutal mistake a trader can make: getting shaken out of a trade at the absolute worst possible time. Oh man, just look at this chart for Hovnanian. You see the buy point, and then you see the sell point, and it is right at the bottom. I mean, the exact bottom, just moments before the stock decided to launch into a massive rally. This is the kind of trade that keeps you up at night.
What makes this kind of situation so tough is all the conflicting signals you're getting. On one side, you had good news. Insiders were buying, home sales were looking better. But on the other side, you had major red flags. Technicals showed the stock was overbought, the company had risky debt, and another analyst downgraded it. It's total analysis paralysis.
And this quote, wow, it just perfectly captures that psychological trap. When you're stuck in a losing trade, it feels like you're doomed either way. If you hold on, it's just going to keep dropping. If you sell, you know you just marked the exact bottom. It is a classic trader's catch-22. And that's exactly what happened. Our trader decided the risk was just too much, so he sold and took a 27% loss. And then, just 2 days later, the stock took off on what he called a straight-line run to the stars, leaving him behind with nothing but a loss. All right, so after walking through that minefield of trading mistakes, what can we actually learn from all this pain? Let's try to boil these lessons down into a practical checklist that you can actually use.
So here's your survival guide. First, from that Medivation disaster, remember to keep those high-risk speculative plays to a very small part of your portfolio. Second, if you ever find yourself in a dead cat bounce, the rule is simple: sell now. From Coldwater Creek, we learned that a tight stop-loss can be a double-edged sword. It might cut you out of a huge winner. The Hovnanian trap teaches us to respect technical warnings even if the news sounds good. And finally, a simple but powerful one: if you keep losing money in a certain industry, maybe just stay away from it.
And that leaves us with one final question to think about for yourself. Are you the type to sell too late because of hope? Do you sell too soon out of fear? Or do you panic and sell right at the bottom? Knowing your own weakness is really the first step to making sure you don't fall into these same traps. Let's dig into the hard data behind what makes a truly incredible investment. We're going to use the fantastic research of Thomas Bulkowski to lay out a data-backed strategy for finding those stocks that can, well, change everything.
I mean, that's the dream, isn't it? The 10-bagger. A stock that doesn't just grow a little, but absolutely explodes. It sounds like finding a needle in a haystack, for sure. But what if the data could act like a magnet, pulling you right to the haystacks that are most likely to have a needle inside? All right, here's our game plan. First, we're going to learn how to hunt for hidden value. Then, we'll put together a toolkit of key metrics. After that, the main event, the blueprint for finding those 10 baggers. And finally, we'll talk about when to sell and wrap it all up in a handy checklist you can use.
So first up, let's talk about finding opportunity. The real key here is learning to think differently than everyone else. You know, the biggest gains are almost always found when you go against the grain and buy what everyone else is practically giving away. This right here, this sums up the core idea perfectly. On one side, you've got what most people do. A stock tanks, and the gut reaction is to panic and get out. But on the other side, you see what the data says. That huge drop, that moment of peak fear, that could be the exact opportunity a smart investor is looking for.
And check this out. Here's the number that proves it. The research shows that stocks that have fallen 50% or more from their peak actually end up outperforming the market the very next year, 68% of the time. So this isn't just a gut feeling. It's playing the odds based on hard data.
Okay, so what other clues can point us toward that hidden value? Well, first, look for what they call fallen angels. These are great, quality companies that have just hit a bit of a rough patch. Next, think about company spin-offs. That's where a new, hungry management team can really unlock value. Another huge signal? Watch for company insiders, the execs, making big buys of their own stock when the price is low. And finally, And this one is pretty counterintuitive. Look for companies that have just cut their dividend. The data shows the best time to get in is actually after that bad news is out and the stock has hit rock bottom.
All right, so we know where to hunt. Now let's build the toolkit so we know what to hunt with. We're going to focus on 3 really simple but powerful metrics that the data says can signal a real bargain. First up in the toolkit is the price-to-book ratio, or PB. Just think of it like this. If a company had to sell everything tomorrow, all its buildings, equipment, inventory, and pay off every single debt it has, what would be left over? That's its book value. The PB ratio just compares the stock price to that real-world tangible value.
And here's the key takeaway. The data shows again and again that stocks with a price-to-book value under 1 tend to do really, really well. You're basically getting the chance to buy $1's worth of company assets for less than $1. It's a fantastic starting point.
Next up, the classic price-to-earnings ratio, or PE. This one is all about expectations. It tells you how much the market is willing to pay for $1 of a company's profits. A really high PE means people are betting on huge future growth. A low PE, on the other hand, can be a sign that a solid, profitable company is just being overlooked by the crowd.
Now, the research actually found a specific number to watch. For the best performance, the data suggests you should focus on stocks with a PE ratio below the median, which was 17.1. Staying under that line helps you avoid getting caught up in the hype and overpaying for growth that might not even happen.
And the last tool for our kit is the price-to-sales ratio. This one is incredibly helpful, especially when you're looking at younger companies that might not even be profitable yet. It's super simple. It just compares the company's total stock market value to its total annual sales.
And just like with price to book, the magic number here is less than 1. The data is pretty clear that companies with a PS ratio below 1.0, meaning their entire value on the stock market is less than what they bring in sales in a single year, tend to outperform for 5 years or more.
All right, now for the part you've been waiting for. We know how to spot value. We've got our toolkit ready. Now let's put it all together and go hunting for the ultimate prize, the 10-bagger.
So where do these incredible performers come from? Well, the data couldn't be clearer. They come from the land of the small. Just look at this chart. An absolutely staggering 77% of all 10-baggers are small-cap stocks, companies worth less than $1 billion. That's where the explosive growth is hiding.
So here it is, the data-driven blueprint. Let's break it down. More than half of all 10-baggers started out with a share price under $5. They had low valuations across the board, half of them had a price to book below 1.5, and over half had a price to sales of 1.0 or less. And this last one is huge. A massive 87% paid 0 dividends. Why? Because they were pouring every single cent back into the business to fuel that growth. Now, just let this one sink in for a second. Almost 2/3 of these monster stocks were actually losing money the year before they took off. This just hammers home that contrarian mindset we talked about. You have to be willing to buy what looks weak, what looks scary, because that's very often where the greatest potential is buried.
Okay, finding and buying a great stock, that's only half the battle, right? If you want to actually realize those incredible gains, you've got to have an exit strategy. So let's see what the data tells us about the smart time to sell.
The data gives us some pretty clear warning signs. A big one is when the company's PE ratio climbs higher than it's been in 3 years, or when its total market value grows to be more than its annual sales. You can also watch the chart for topping patterns, like this inverted V shape, which often signals a reversal is coming. And maybe most importantly, don't get greedy. After a stock has a 10-bagger run, the data shows that on average, it drops 66% the very next year. Knowing when to get out is absolutely critical. Whew, we have covered a ton of ground. So let's distill all of this amazing research down into one simple, powerful checklist that you can take away and start using. Let's put it all together. Here is your ultimate checklist. First, buy the big dips. Don't be afraid of them. Second, target those low ratios we talked about, price to book and price to sales under 1. Third, remember to think small. Hunt for those hidden gems in the small cap space, especially stocks that start under $5. Fourth, always watch what the insiders are doing with their own money. And finally, always have a clear, data-driven plan for when you're going to sell. This isn't about emotion. It's a framework to help you make smarter decisions. So, look, this research gives us a map. It challenges a lot of our gut feelings and gives us a real statistical edge. Now, the data doesn't get rid of risk completely, but it absolutely points us toward opportunities that almost everyone else is overlooking. The only question left is, now that you have the data, what are you going to do with it?